So we've had a big down day. I think I'll kick off the discussion. What has been happening here is I think there are different type of people. Some people who are looking at day-to-day movement, somehow trying to, and day trading is definitely not something that I indulge in. But what I do try to look at is two time horizons. One is the positional moves from the trading angle, which is try to capture a move cycle to cycle. We call them momentum cycles, and which is why we use the RMI indicator along with a handful of tools, which I believe are more than sufficient. Once you have 5-6 momentum tools that help you ride an entire cycle in the market, you try to attempt to do that. But of course, no system is infallible, which is why we've moved towards complete market analysis, which I call is putting together everything from Elliott wave, which is the opinion taking methodology, momentum analysis, which allows for trend following, macro analysis, which allows us to filter out what is happening at the larger degree in terms of trends, across the world, across the globe, and thus understand the business cycle better. So that then also gives us a context which goes beyond, capturing the cycles, which is the trade, versus also trying to capture the investment positioning that we should have at a particular point of time. And in that sense, I would say I'm more into active management of investing rather than only something which is temporary or does not last for a long period of time. Because the idea really is to be able to take that shift, especially if there are large drawdown risks. Now, I know there can be long-term investors who can argue that drawdowns are a part and parcel. If you can even sit through a 50% drawdown on a 10-year basis, if you are going to compound at 30%, it may or may not matter. But of course, that is a style factor that one has to really fit into one's thinking. But if I am able to, sense or judge that there could be a significant drawdown in a top-down approach where we look at the market first and look at the environment first, then I do think about taking a step back, increasing the cash component, and rethinking all over again if there is that kind of a risk. Now, of course, if we can draw a period which is going to last for several years, then we might not want to even de-risk. If you can think that yes, this is something which will last for like a 10-year period, then why even bother? So these are different things we do try to think about along the way, and based on the setups we see on different parameters, we may give more or less importance to each, and so changing accordingly on what we should give more importance at what point of time, so that we can position accordingly. So this sort of been the framework that I've built over time to try and follow and understand as to what is working and what is more important at a particular period. So, having done that, I think over the last 2 years, the aggressive stance was to be with the idea that once the dollar had peaked in 2017, it would be into a 7-year bear market, which means going all the way to 2024, which meant a long enough period to stay on the bull camp of reflationary assets. But that view sort of has ended early with a 5-year consolidation, which means we didn't go on for 7 years, 5 years between 2017 and 2022, and we have the dollar breaking out of that range. That has been one of the big changes that we've really seen, and that has happened along with another big change, which is a reversal in what we are seeing as higher bond yields, right? A reversal in what the bond market has been doing for a very, very long period of time. Those two have become two major factors driving the thought that whether we should be going into a risk of environment in the months to come. And I think post April, after having stood the test of 15,600 once, I thought possibly it's time to take a step back. Now, this has of course been the one of the most broad-based periods of rotation that I've seen in the market. I have seen phases where certain stocks or sectors do well and outperform the index even midway through a bear market. Some of them recovering from their previous phases, some of them completing something like, for example, if you talk of 2001, halfway through the Y2K bear market, Reliance Industries was still making a new high at that point of time. And we did see a recovery in some companies, which were going through a downdraft start through that time frame as well. Companies like, for example, BHEL or Tata Power, or some of them actually bottomed out during the decline phase. But then they had been through a decline phase for almost 6-7 years at that point. Now, what we've seen in the last 2 years is many sectors start to participate on the upside, and that sort of gives a sense that you have started something big at a larger degree, longer term, that can be lasting. Many sector indices breaking out of 7-year, 8-year ranges, which was a very interesting fact to note and take cue of. But the what has happened in between is what I explained, that the macro backdrop suddenly weakened, which sort of opens up the idea of fine, even if you have significant first waves of buying, value buying coming into certain sectors, have we overdone that, and are you going to see a deeper retracement of that? Because if you even look back, uh, has this happened before? Yes, between 1998 and 2001, everything from a Reliance to a Larsen to an M&M would have gone up and down and retraced 60 to 80% of those gains in what we call first and second waves from an Elliott wave perspective, which means the first round of buying into stocks in the expectation of a reversal in economic activity, and then that gets stalled due to some external reason, doesn't happen right away, and then you build on it all over again from 2001 2002 onwards. That is sort of what we saw happen back then. And what I fear right now in the backdrop of what is happening in the US and Europe is that maybe we witness something like that all over again. You've seen significant breakout rallies for sectors that were looking like they're starting new trends, companies that were trying to build on their businesses. But we are sitting in an environment that is worsening and weakening as we speak on a day-to-day basis, and may have still far to go before things really start improving. I think that is the sense I've got, and which is why in April I thought of pulling back significantly out of the markets. Again, 15200 was giving an extreme oversold reading across sentiment data, sufficient to say let's go in and take a trade on this, both on the investment side and on the trading side. But once we crossed 17300 to 17800, I sort of moved out of that, and I wrote. I think we did these spaces a month ago. It's taken a month, which has been a long period to think about whether we were right to take those actions or not, because since I wrote the long short report, then we did that spaces on, I think, somewhere in the third week of August, and the market had peaked at 17900, sold off a bit to 17150, and then went back right up to retest the 18100 mark. And that period, because it's seen outperformance of mid and small caps, specifically the Adani Group, and all that contribution to the indices, has sort of got people thinking about everything from things like decoupling, India's long-term story, India's stronger macros, and so on, to the point where we start ignoring that it is not possible that we behave differently than what's happening in the rest of the world. So none of those factors could be wrong, but at the same time, in the near term, liquidity could play its largest role in terms of what markets end up doing, and then when we think about things like valuations, liquidity is an also important play over there, which is where, irrespective of macro growth and whatever we can talk about, if you tighten liquidity, automatically valuations should be much lower. This is sort of what sort of some of the thoughts that went through my mind. And so last month of market watching, 17900, 17100, 18000, and all the outperformance did not really change what is happening on the dollar, what is happening in the bond market, what is happening in US equities, all of which look at the edge of a major breakdown that may be in progress even right now. I've put out a chart, I think, on Twitter just now, which is some time back, showing that US indices are at a breakdown point. They sort of broken and started to trade down of that. And this kind of a counter trend rally and breakdown of trend lines is something we've seen through bear markets over and over again, and it never ends well. So that's one non-confirmatory. We're also seeing similar action, say, across currencies, especially my expectation, I think 5 to 8 days back, that the Chinese yuan would start weakening, and we are seeing that spread across Asian currencies and the South African rand, which means that the strong dollar effect on various currency pairs still going on out there. So we haven't really ended this. And the third debate which goes on is, if things are so bad, why would the US let this happen? I will later ask Ritesh to also jump in and throw his thoughts on that. But what I've understood listening and hearing to everyone who speaks on these issues is that there are two camps. One is, of course, that thinks that if things are so bad, we that at some point of time the Fed will pivot, and therefore we should not be too bearish. But simultaneously, the fact is, by the time they pivot, they may wait a little longer, and that could mean a couple of months, maybe a quarter or two. And in that time, they would still be probably in a rate hiking mode and quantitative tightening mode, which means that it would continue to slow down the global economy, and tighten liquidity. And both of those factors put together would at least keep global markets under pressure. And in a tightening liquidity environment, if bond yields in India start to break out, I think today they were almost breaking out above 7.26. And if that has happened, I have not checked the final closing. So I'm just going to take a quick look at that. Yeah, so just on the margin, I mean, we've closed 2.66. It's just at the breakout point, maybe marginally done the breakout. So if it does that, then bond yields in India probably head towards 8 to 8.5%. And similarly, our currency is seen some sort of consolidation here between 80 and 79, and is, in my sense, setting up to move towards at least 82, if not go to 85, 87, if the global dollar rally continues. So those all of those risks in line keep me on the side that this rally that we've seen, even though it has stretched, has probably ended because my momentum cycle indicators have gone back into sell mode after having whipsawed with a lot of negative divergence, and therefore everything that's happened over the last few weeks looks like a false breakout as of now. And the volume on the downside being far heavier than the upside today, signaling that we've probably peaked here and the next major leg down has started. Now, whether the next major leg down is going to hold 16,700, which is going to be the debate point. Some people may also hope that it probably holds the monthly ranges, which are somewhere between 14,500 and 14,000, which is way, way lower. And even that much would cause sufficient damage, I think, to markets and individual stocks or portfolios. But given the overall backdrop, the way I think about it, it's not whether you'll go to a particular level, but that the downside risk is open. Now, when we say downside risk is open, which means we are not going to cap and say, okay, this is the level, it goes there, and then you start buying. But that the risk is that even levels break. So that's the kind of environment we are in, where the risk is of levels breaking and prices sometimes, just like they overshoot on the upside as they have done now, in terms of this false breakout above 17,900. The same happens on the downside, which is we tend to overshoot on the lower side, and that opens up further risk. And well, we can look at it as risk, or we look at it as opportunity based on how you're positioned. For me, that means that I increase my cash levels sufficiently so that if the opportunity presents itself, I'm able to invest at much better valuations in the stocks that we continue to like, in the sectors that have given breakouts over the last 3 years. Of course, they remain in focus, but the whole point is that the run has exceeded itself on the upside and could probably show a much steeper cut and provide us with much better opportunities to re-enter at lower levels going forward. And so that is what I am positioning for. And I think today was probably an important signal, like I said, because the RMI indicator goes into sell. We closed below the 20-day, we closed down for the week, and we sold off on heavy volume. A lot of that on the Nifty sort of confirms that the next leg down has started. A little more confirmation required on Bank Nifty, but we do see an impulsive 5-wave decline on the hourly chart, which is a starting point of a downtrend. What we'd want to see is daily charts to also confirm, which the Nifty has done, but Bank Nifty has still not done. We can see it on Nifty 500, which is a more broad-based index. We can see it in the IT indices, because they are mimicking what the US Nasdaq is doing. If it's broken its previous lows, the IT index today is already broken its previous low. So that is sort of the closest sector which is mimicking what's happening in the US tech sector. And so and I think we've seen a sort of near 61% retracement in the metal index, which was the part of the reflation trade, and so that is also almost done. So that's my overall picture. I think the bear market has not, in my view, the bear market has not ended. The bull market has actually gone through a lot of sectoral rotation. So if we saw the IT sector peak in say January, we saw the small cap index peak in January. We've seen the oil and gas sector peak much later on, metals in April, oil and gas in May, and we've seen the power sector, capital goods sector indices continue to new highs recently, which I think are probably peaking now. And that would sort of be a 6-8 month kind of sector wise distribution phase. That is how I'm looking at this. And once all the sectors are done, I think you'll see a far more broad-based decline from here than what people are thinking. And therefore, this run, which whatever started from 2020, is probably ending here. And once we've seen a meaningful cutback retracement, is when I would expect something else to start on the upside. So this is my assessment of the current picture. I'm not sure everybody sees it the same way. I'm open to alternate opinions and thoughts, and that's what I will do before taking on questions or reflecting on my views on any more things. Let me just bring in. I'll bring in Ritesh with his perspective on the global markets and macro. So welcome, Ritesh, and I'll let you take it on how you're seeing it from that side of the world.
Hi Rohit. Hi everybody. Uh, so Rohit, I have always believed that you should never fight the Fed. Always. Okay. Whenever Fed is increasing the interest rate, whenever Fed is tightening the policy, whenever Fed is changing its stance, you should always be playing on defensive. Now, for the first time in history of our career, possibly we have to go 50 years back, when inflation was this high in developed world, and more so in US, which you are finding it to be very sticky. For the last 3 months, we've been talking about couple of things. Unemployment rates will go up and inflation will top off. But all the three times, analysts have been proven wrong. uh, Inflation is becoming much more sticky. That means it is getting ingrained in the mind, and unemployment is not rising. Now, I can go into the reason of why unemployment is not rising and why inflation is sticky, but that is a separate that is for separate discussion. The current discussion is clearly that Fed cannot allow inflation to be ingrained in the mind of people. Now, one thing which is happening, which a lot of people stop noticing, that US M3 growth rate is rising. Actually, M3 growth rate data they have stopped giving, it is M2. So the money supply is actually not shrinking as of now, and velocity of money is rising. You can go to Fred website and you can look at that the velocity of money is rising. You can also look at US banks loan growth is rising. So when these two things are rising, that means the economy continues to do very well. That means the inflationary impulse is quite strong. So even though Japanese and Europeans are pleading with Fed, actually Japanese pleaded with Fed couple of days back when they said we cannot do anything about yen depreciation. They were actually pleading to Federal Reserve Bank to stop raising the rate. But how can Federal Reserve Bank stop raising the rate at this point of time when the inflation is so high? So we are coming to a point where Fed has no choice except to break something. And unfortunately, we are closer to that moment as of now. Markets have been very complacent. You can see it in VIX. Okay, people have been used to buying the dip. Okay, I believe in the next 1 or 2 months. Now, I do not have a long term view as of now at this point of time, simply because of oil. But for the time being, it seems that Federal Reserve Bank will continue to be having a very hawkish policy going forward. And at least till mid-October to October end, okay, whatever you have said on prices in India, it is possible because dollar index is just breaking out. Dollar bond yields are breaking out. When was the last time you saw 4% on 1 year bond yield in US? It's just mind-boggling, actually. Those rates are mind-boggling. In Canada, where I am, the insured rate, basically the insured by government agencies, for 3 to 5 years on deposits is 5%. When you have these kind of rates, at that point, you should expect that the economy should slow down. But the US economy is not slowing down. Canadian economy is slowing down. Japanese economy is slowing down. European economy is slowing down. So historically, Fed has stopped raising the rates whenever emerging markets and other economy, Japan and Europe has pleaded with them not to raise the rates. But this time, US has a different problem of 7% inflation. And they have said that they want the inflation to come down to 2%. I do not believe that the inflation will come down to 2%, but it could probably go to 3 to 4% and stay there for a long period of time. This is exactly what happened in 1944 to 1952, but that still means that dollar index can continue to strengthen over here. And as you have said, that it is possible that markets are breaking down at this point of time, because people have been complacent till now. They are not taking Fed seriously. So this is not the time to be playing on front foot, simply because we are going to have a rising dollar, rising bond yield, which will suck out the liquidity from other asset classes. So this is just my 2 bit over here.
You mentioned something that you can see a slowdown in the Canadian economy and other economies, but not in the US. Is there
Yes.
a particular reason there's such a divergence?
Yes. So the savings which were accumulated by Americans were not spent actually, till some time back. Now they have started spending those savings. So their saving rates is coming down. The credit, you listen to Amex con call where they are saying that the spending on credit card continues to be doing very well. Look at the bank credit growth rate; it is at 10% as of now. Okay, year over year, bank credit growth rate is going up. So US economy, as of now, you can see it in GDP number. Maybe GDP number is a separate thing altogether, okay? But you can see that US economy continue to be sustaining these rates as of now. Yes, housing activity is slowing down, but rents have started moving up. Rents have almost 20% weightage in inflation, okay? So overall, it could be slowing down a little bit, but it is nothing to be worried about as of now for Federal Reserve Bank. Unemployment continues to be between 3.6 to 3.8%. They have stated that they want unemployment to go to 5%. For unemployment to go to 5%, we are far away from here as of now. So, and Fed unfortunately drives the car looking at rear view mirror. So by the time they reach 5%, they would have broken something in global markets.
So I'll just pose two questions. The first one is that one of the contra opinions is that, well, if they know they are going to break something, why would they go that far? That is one part. And second, I would like you to just reflect on if I mean, you'd be watching Indian markets as well, and here the enthusiasm is has been at a different level because of the run that we have seen in several individual stocks, and there's been a long discussion on whether it's decoupling or whether our macros are better. Do you have any view on what is happening here, and what would be the impact of all this on the Indian market?
So the first question is much easier actually. The second question is I'm searching the answers myself for last couple of months talking to people. The first one is quite easier actually to reply. The thing is there is a pain point which will be there in the next month or so, where markets are down 20, 25, 30%. Okay, suddenly near term starts looking bad and unemployment starts rising. So Fed will have to stop at least temporarily over there. And secondly, please remember that we have US midterms in December. So if Fed continues to raise the rate into midterms, they will be be called out for political interference. So whatever they would want to do, they would want to finish it by October as of now, and they would not be going hard in November, December. So that is why I believe that for the time being, October looks like to be a place where you should be watching Fed closely. By that point of time, they would have done enough damage to the market. Are they happy with the damage? or if they want to do more damage. The more damage will not come in November, December. The more damage will come in January, February, March. So what you are seeing is a phase where you will have, a steeper correction going into October, and possibly after that, Federal Reserve Bank will just put it on a back foot for the time being and take it off forward from there. Now, the second question is a very difficult question actually. I've been looking at two charts, ratio charts, and I have put it on my Twitter also, where India is breaking out against, Nifty is breaking out against Dow Jones, Nifty is breaking out against S&P, well-defined ratios. Now, I'm not a technical guy. I have to find something ki why India continues to do so well. Okay, and honestly, I do not have the answer except for one thing: yes, there are enough data points which says that India's GDP, nominal GDP growth rate of 14%, India's debt ratios compared to rest of the world are far superior than developed world. So is it possible that developed world money and developed world fund managers have started looking at India, and they are willing to put money in India even at this elevated valuation? And some kind of money is coming out from China and Taiwan. So China and Taiwan, and possibly South Korea. China has actually disappointed global investors for a long period of time, but still people continued putting money till last year. After the new pivot of Russia-China war, okay, the middle ground is found in India, and then you look at 7% is the normal inflation in our country. 14% GDP nominal GDP growth rate is you will not find anywhere in the world. Debt to ratios at household level, corporate level is far superior to anywhere in the world. Yes, government debt ratios are a little bit higher, but nominal GDP will take care of that thing. So more and more global investors are talking about this thing, and that is why some kind of ETF money, possibly single stock ETF, or an ETF where India has a higher allocation. That kind of money is coming to India. Having said that thing, if there is massive losses in global assets and markets become illiquid, these guys will start, at least the near term macro tourist will take out some money from India, and that can do the damage which you are talking about. Okay, and the damage can be only possible if US markets breaks down. Then everybody looks at India. Why is it standing? So we have to sell, take profits over there also. So India could be a collateral damage. Otherwise, after a long period of time, I believe that India's macro are far better than that of G7 countries.
Yeah, I think that's the view that is strongly coming out. That we've done a lot for our balance sheet across, whether it's the private sector or the banking system, and that is getting everybody's attention. But are we overlooking risks? Is where probably I'm coming in and trying to think about the impact of what is happening in currency and bond markets on our own currency and bond markets, because our own bond yields are holding steady. At the same time, we are talking about making it part of certain international indices, and if that happens, there'll be a lot of flow. And then I look at the long-term 10-year GSEC chart. Its upside potential is somewhere up to 8.7, 8.8% if it does get there, if at all it gets there. And in an environment where yields are rising across countries, I'm wondering how we can keep that differential. So that is one aspect, and the other one is, of course, the dollar itself. So I guess those uh, remain on mind.
So Rohit, I agree with you on both these things what you are saying. But if you see over the last couple of months, we have maintained, so Indian bond yields and Indian rupee. The strength of these two things have percolated down into Indian equity markets. But if you are of the opinion that we are headed to 82 to 85, some people are even talking about higher than that on currency, and we break out above 8%, then just by discounting method, these levels cannot be sustained in equity markets.
Yeah, so I guess the valuation to bond yield is the thing which try to throw some light on that. You get title bonds are high, then can we really give the same valuations to the market, and therefore probably you get a much higher, lower valuation, and that's the only source of derating that may be possible for the market itself.
There is one more point I wanted to make actually. If you see our credit growth rate is at 15.7%, the deposit growth rate is less than 10%. Okay. So, to fund the credit, the deposit rates have to move up in an environment where you cannot depend upon global liquidity. So, whenever the deposit rates move up to sustain the credit demand, then the money moves out of financial markets into the real economy. So you can see that either money can stay in financial markets or it can remain in real economy. To fund the real economy credit growth rate, money has to come out of financial markets.
So you're saying that that growth in India needs to get funded from financial markets. That's sort of the linkage you're making.
So the money can either remain in equity markets or it can remain in fixed income markets. When the fixed income yields goes up, the money has to come out of equity markets to fund fixed income growth. The fixed income yields are becoming quite attractive in India, and they will become more attractive because banks have to fund credit growth rate. So the money, fixed income will become much more attractive versus equities going forward in India.
So that would be looking at earnings yield to
yes,
bond, and that kind of ratio. Deepak, I have sent you, Deepak, I have sent you an invite to speak. If you could join the conversation. Okay, while he's trying to do that, Amol, you can speak. You can throw in your thoughts if you have any on.
Sure, Rohit. Can you hear me?
Yes.
Yes, Rohit, thanks. I heard you in the beginning, and you have mentioned it during your previous spaces as well as now that a diverse point of view is what we can discuss. So far, it looks to be the bullish camp when I hear you as well as Ritesh. Without saying that I'm in the bullish camp, but what I want to present certain data points recently declared. So I will start from mutual funds. We know in the month of April, May, June, where those 3 months where we had negative closings, monthly negative closings on the Nifty chart, as well as when we saw the bottom of 15,200. FII selling was close to 95,000 crore rupees in those 3 months alone. And out of that, about mutual funds, domestic mutual funds did close to 45 to 50,000 crore rupees of buying. So I would say somewhere around 55-60% of the buying during that time. And there is a popular, opinion misconception is in the market where it is said that DIIs are giving easy exit to FIIs. Now, I don't hold brief for anybody, neither for FIIs nor for DIIs, but it's simple fact that DIIs or specifically mutual funds, they have a mandate to invest in the market, right? That's why investors put money via their SIPs or lump sum allocations, including there are STPs, systematic transfer plans, and other things. So the point that I'm trying to make here is recently, now that we have a mutual fund fact sheet out for the month of August, the balanced advantage category itself, one category of mutual funds alone has AUM of close to 1,50,000 crore rupees. And if you see the fact sheet data for a few of the largest funds, if I take example of one of the largest funds, ICICI Prudential Balanced Advantage Fund, it has close to 40 to 43,000 crore rupees of AUM, and they are, if my data is correct, they are sitting on 65% cash. By cash, I mean debt, where they have mandate to go as high as 80%, if the valuations are attractive. Now, the point that I'm trying to make here is going by 50% cash allocation or debt allocation that balanced advantage funds have, I feel that there is significant amount of money that is going to enter at every level. Now, when we say every level, now those funds also use their own internal algorithm or metrics whereby at every 1% drop in PE, at every 1% rise in dividend yield, those funds will make purchase. But I'm trying to say that there is close to 50,000 crore to 1 lakh crore money sitting only in mutual funds to enter the market, where the mandate of the mutual fund is to deploy. So how do you take this? In the sense, I would feel that the global sell-off, we will not be falling, we won't be last man standing. I think that point is made by you and Ritesh both, and it's well taken. But if there is a wall of money that is still here to enter, and I think Ritesh also mentioned that point about India, the kind of growth projections that we have for the size of our economy, those are very, very robust. So what, in your opinion, since you have handled that side of things also in the market, what in your opinion would further accelerate this sell-off when you have that much of money still to be deployed in the markets? I think you are probably unmuting your.
Sorry, there was a lot of noise coming from there, Amol. Just check your background noise. But yeah, I got your question. See, of course, when it comes to net buying, I don't know if Ritesh has, because he's handled the fund side, has any inputs on that. What I can say is, when I look at things like FII data or potential cash, what happens is sometimes in markets is far more behavioral, which is when markets are rising, people become more fearless and they tend to deploy. At the same time, what also happens is that when markets fall, people also become more fearful. So at the same time, as they may be willing to deploy at higher levels, sometimes in a falling market, and we know the macro environment, you're reading everyday news, people may or may not necessarily deploy additional cash. For all they may increase cash levels. So predicting behavior of money which is sitting on the margin, because I think funds do have room to decide whether they should keep higher cash allocations or not. It is I'm not sure if I can simply look at, okay, there's so much cash sitting and therefore market will not fall or will rise. I'm not sure if that kind of an argument works.
So Rohit, if I may jump in over here, okay. Uh, from a fund point of view, which I can clearly tell you, I cannot talk about balance advantage category as such, but in a normal equity fund, okay, if the markets, let's say, continue to fall and all, we would not normally be keeping higher cash. We would actually be, the industry would actually be deploying the cash. Okay, they will not be increasing the cash. And yes, they will keep something for redemption, but they will actually be deploying the cash because everybody wants, to participate on the upside. And if the cash is there, then, you will be buying assets much cheaper. So that is the way of looking at the mutual fund industry cash. Now, there is one point which I missed, and I think Deepak asked that question. What will be the catalyst, okay, of a further drawdown? Now, historically, assets have been sold indiscriminately globally when interbank funding is not available. So let's say something happened in Europe, and European banks do not get funding from US banks, and these European banks have lot of assets on their book, which they funded from overnight cash, which they borrow from interbank. You might find, some of you might find it a little bit complicated, but it is not. It is like we all banks run assets which are borrowed from money which is taken for one day, and then next day you roll over that money. Every time we have found that indiscriminately assets have been sold, they have been sold when one financial institutions has been in trouble. Okay, it could have been in March, some European bank, 2008-9. You know what happened during Lehman crisis. So you can all observe this phenomena by looking at OIS LIBOR spread. Okay, the spread today tells me that there is no systemic risk as of now. All the banks are properly funded. Fed is taking care. This time, Fed is taking care that yes, the assets will unwind, but at an orderly pace. If there is going to be an orderly pace decline, that is a very big if there is going to be an orderly pace decline, then I do not believe, looking at India's fundamental, that it will be very painful. That is the whole point I want to make over here.
I see Sanjay has left the conversation or dropped out.
Hey, can
Yeah.
I just something?
Yes. Yeah,
So,
jump in.
Amol, I'll just, I guess one of the things that is giving a lot of confidence in the view that you proposed was the fact that you saw a fair bit of resilience in the market in the months of May and June, when domestic outflows were, rather domestic buying was fairly strong, right? If you look at the foreign, selling that happened, I'm looking at provisional numbers. May and June, you had about 110,000 crores of selling, right? And despite that, you really did not see much of a correction in the market. But if you were to go back just a few months earlier, you had March and February, where the market sold off a fair bit, and the quantum of selling was a lot lesser, right? And the reason I'm trying to drawing, and let me go back further, and let's go back to March 2020. The markets fell 20%, and the total quantum of selling was, in fact, just 80,000, less than 80,000 in the months of February and March. The reason I'm highlighting this out here is because purely looking at these numbers doesn't give you a full context, versus really trying to understand the aggression of the domestic institutional investors. Now, you could have typically, if let me go back to the numbers that you shared. You mentioned that about 50% or 55% of the buying that happened was mutual funds, while the remaining 45% was obviously not mutual funds. It's anybody's guess as to who that is. I mean, we all know who it most likely would be. And the aggression, and okay, so just keep this in mind. The IPO of the largest domestic institutional investor happened sometime in March, April, right? So till then, there was a lot more apprehension by the institution to be too aggressive in buying in the market. That dramatically changed, and the numbers will indicate to you that dramatically changed in May and June and July, when despite even bigger sell down by foreign institutional investors, you barely had any impact. The point I'm trying to make is that if there is an intention of a particular institution which manages over 100 billion or 150, maybe 130 or 140 billion dollars of equity, and much more in debt, to try and buy aggressively, right? There's nothing much you can do. Markets go up and down because for every buyer there is a seller, but it depends upon the aggression of the buyer and the aggression of the seller. And there's been a very significant difference in how aggressive the buyer was pre-IPO and how aggressive the buyer was post-IPO.
Sure. Yes, that point is well taken. I think you are absolutely right. There would have been considerations of where the market levels are because we have seen that market levels do affect the overall collections or the subscriptions in the IPO. Rohit, is there still a background noise? If there is, then I would probably, till I go to a quieter pace, I would probably mute myself.
Oh, that's much better. But
Okay, great. Okay, great. Thank you. I just wanted to add one more point over here, and we only spoke about one category of balanced advantage funds. I think the next data is known to everybody else because it has got a lot of press coverage. We have monthly SIP inflows also in excess of 12,000 crore rupees a month. So that probably over next couple of months, that is another 25,000 crore rupees. Rohit, your point also is well taken that it is behavioral. I only would reiterate one point over here that the mandate of these funds is to remain invested, and I think Ritesh confirmed it not specifically for balanced advantage funds, but a lot of other actively managed equity funds. So I just want to put this point across that there is a lot of money in the sidelines. This is not to say that if there is a fall, it will be completely absorbed, because as you rightly said, the sentiment also counts for something, and including the kind of sell-off that we are seeing currently in US markets, global markets. I think we might see those negative effects, but it will not be probably a runaway sell-off, the kind of what people are today getting actually fearful of.
Okay. I'm not sure if Deepak is joined in from his phone because he was on his desktop. I've been trying to get him to join the conversation. Fact Finder, you want to reflect anything on
I want to just ask
to-
Ritesh about this
Yeah.
one question. Ritesh, what is your view? So there's a very common view. I have a view myself, but there's a very common view amongst a lot of investors saying that, what, the US dollar has peaked and it'll fall from here. And I think that's giving a lot of people fall. But, this view has been reiterated several times, especially in the last 3 to 4 weeks. Right. And, especially when the dollar index touched, I think, 120 or something. But what is your sense on this? Do you think that there is merit in that argument? And one of the points people have put forth is that, US dollar as a proportion of reserve currency has reduced over the last 2-3 years. Any thoughts on the US dollar?
Yeah. So this is something which is happening for the first time. Okay. Dollar index DXY is made up of mostly the developed market currencies. So you can see that sterling is down majorly against USD. Canadian dollar is down majorly against USD. Euro is down. But on the other hand, you are finding that even JPY is down. Okay, so there is actually a direct correlation between JPY and CNY. Okay, Chinese yuan. By now, Chinese yuan would have broken down completely. By now, Brazilian real would have broken down completely. Vietnamese dong would have broken down. Indian rupee would have broken down. But what you are finding now is that US is very strong against the developed market currencies. US is not so strong versus the emerging market currencies. Now, it's very, you should never say it is different this time. But what if Chinese, who import $700 billion of commodities every year, and some of that commodities, let's say, 10% of those commodities, they are not buying in US dollar, but they are buying in some other currency not related to US dollar. What if India is importing oil and not paying in USD and paying in some other currency? So is something changing after the Russia-China war, where our currencies are not getting hit as much as what we are seeing? Dollar is doing a damage versus the other developed currencies, developed market currencies. So this is the first time I am seeing it. And the second question which you made was USD as a percentage of reserves. Now, USD as a percentage of reserves, I am not having the right number as of now, but I believe in the last 3-4 years, it is only down 3 to 4 percentage points. So it is not that that space has been taken by anybody else big, because it is just a small difference of 3 to 4 percentage. So that is that has not changed. Dollar still continues to be the reserve currency by a fair mile, and Chinese are struggling to increase their share, which after obviously this Russia Ukraine thing, they have not been able to increase in global reserves.
Thanks a lot, Ritesh. Can I add something over there, Ritesh?
Yeah.
From my point of view, I think actually looking at my argument against this entire argument of looking at reserves, and you agree with it, but my argument is that I think people are looking at the wrong thing. Rather than reserves is akin to assets, but what really hurts people is liabilities. And if you look at the Bank of International Settlements and you look at the global reserves of dollars, on one side you have US dollar reserves, which I think are in the range of $5.5 trillion. But if you look at the liability side, which is the on which is commonly called the dollar short,
Hmm.
right?
Yeah.
That's about 13.5 to 14
Yeah.
trillion dollars, right? And
Yes.
that I think is the big crux, which a lot of people are not appreciating. It's that your liability in dollar terms is actually far larger than your assets in dollar terms.
Hmm.
Uh, so which is why this some people are referring to this as the dollar wrecking ball. But
Yeah.
the other point I wanted to make is that if I look at the JP Morgan has something called the Asian Dollar Index.
Hmm.
And,
ADXY.
yeah, ADXY, and that seems to have actually broken down, right? And if I to look at things, I guess a fair bit of it is because of the Chinese yuan as well as the Japanese yen. But if you were to extrapolate your entire one of the points that you made earlier was the Japanese central bank has pretty much pleaded with the U.S. Fed, but they can't do much about it. Now the question is that at the end of the day, if you look at countries like Korea, they compete head on with Japan on exports of electronics as
Hmm.
well as automobiles. Similarly, if you look at, I mean, and China, so if Japan is allowing its currency to depreciate, and not like they are in full control, Korea will do the same. And
Yep.
with China slowing down, I don't think they will also. I mean, they will probably have a more managed depreciation of the currency, especially with the fact that China is also easing very very quickly. So the question to you is, with all these Asian currencies, who are competing with each other, I mean, at the end, it's all a relative game, right? So if
Hmm.
Japan depreciates, Korea will say, "Boss, I have to depreciate," and China will do the same. So then, how long do you think the Indian rupee, holds on? And one more thing I want to add when you share your views is that I was looking at this entire news about this India being included in the JP Morgan bonds index. It's only a decision at the end of the day. The actual flow will happen maybe 6 to 8 months from now.
So you have a very valid argument over here. But if JPY depreciates, so what had happened, some 15, 20 years back was Chinese yuan depreciated, the manufacturing shifted from Japan to China. Then 2015 depreciation of CNY happened only because JPY had depreciated. They had to keep themselves competitive, so they devalued their currency, and we had a fall in 2015-16. This time, JPY has depreciated 25% in front of us, but CNY is not depreciating. That it's a managed currency, I understand. They have all the reasons to depreciate their currency or devalue their currency. Okay, but they are not doing as of now. Do they need to do it? I don't know. If they are importing in some other currency and you want to internationalize your currency, would you deliberately go ahead and devalue your currency? Will you tell it to rest of the world that you are going to devalue or depreciate your currency? Then why would I want CNY in my reserves? So is this different? And if CNY does not depreciate, there is not too much pressure on Indian rupee to depreciate. In fact, if global economy does not do very well, oil prices come down, it is great for India. So the whole point is that if CNY depreciates massively, Indian rupee will do it. But if CNY does not depreciate, then Indian rupee, in my view, will not be depreciating as much. Okay. Now, so that is the I'm seeing it for the first time. As I've just told you, I have not seen this phenomena before. At least in the last 30, 40 years, this is happening for the first time. So I'm keeping my options open. that tomorrow there is too much pressure on Chinese yuan, they devalue, they depreciate, okay, 15-20% from here, and then Indian currency goes along with that, and then we have our own problem of inflation rising. Then India goes into a different tailspin altogether. But that is not even in my mind as of now.
Yes, I did some time back try to anticipate where the CNY would move, and my sense was, at least for now, probably towards 7.3, 7.4, which means somewhere going beyond the high that it made a couple of years back, and which may not be very large. I'm not sure if it's a very big move in that sense to really impact anything, unless it spirals beyond that. Then definitely, so incrementally watching it in terms of its impact on various currencies. And as fact finder said, I think so far what we have seen is impact on most of the Asian currencies. So when we see the entire pack, they seem to be moving to it together, which is USD CNY, USD TWD, USD KRW. All of them are seemingly moving together in the same direction. The only other one I found is African Rand also moving that way. So those were like 3-4 of them which were simultaneously moving up over the last week or two.
I should speak.
Hello, Deepak. Deepak, good to have you finally on. Getting you on. Yeah, Sharadji, I'll bring you on. Let me just get Deepak's insights on what is happening and at these levels. What does he think? He's also been speaking a lot on his YouTube regulars, and what we're really trying to throw light on. I mean, I have my own views on what the market has done today. Most of my technical signals all turning to the sell side, but the real question I'm trying to raise here is, what is the downside risk, and should investors, at least the way I think more like a man, what do you say, actively managed fund rather than a passive one where I should simply sit tight. So if I do see an opportunity in one way or the other where there can be a significant drawdown, I try to pull back and take advantage of that. So that is how I am positioned. But do you see the kind of risks in the coming months, and are positioning for them, or do you think it's better to simply sit it out based on holding on to longer term investments? What are your thoughts, Deepak? Okay, I'm not sure he's able to get through. Sharadji, you are commenting. Please go on.
Good evening. I heard Amul and Ritesh. So, to Amul, I would say that mutual funds bought a lot of stocks. But do you know what did they buy? They bought a lot of QIPs and all nonsensical stocks. So that's one point. And having cash doesn't mean it will be deployed and the market will be afloat. That way, a lot of people have money, but it will not be deployed. And about Ritesh, India is very good amongst G7. So I fully agree with him. If 80 crore people are on rationing, we are good. And here we are only talking about economics and world affairs, whereas the topic is who let the bears out? Did the bull market just end? So इट्स लॉट ऑफ ये जापानीज ये अरे क्या करने का है हम बोलते हैं इज CNY है पहले 11 हो जाएगा बाद में 18 हो जाएगा JPY जब भी 120 आया तो हम बोल दिए थे 160 हो जाएगा इट्स ऑन इट्स वे all the currencies are debased If you look at ZAR, it's 18. If you look at Riyal, it's 5.5. Everything is epic. But only thing is, our India is a great story. Now, we can't do away with it. It is imbibed in us that India is a great, great, great story where P ratios are 80, 90, 100, and we are very good. Now, coming to who let the bears out, did the bull market just end? I think this whole move, uh, which started 18 months ago, that time the fundamentals, and this time the fundamentals, there is not much of a difference. Only thing is, there is a lot of propaganda. ये अच्छा है, वो अच्छा है, कुछ अच्छा नहीं है. Things are bad. Few uh, companies are doing very well, that's for sure. But at the cost of the SME and other things. Now, 18 महीने पहले 12,000 था. क्या गया है कि वो 18,000 हो गया? क्या है? It is just our emotion, hope, or मेरा देश महान. Nothing else. Why will you buy equity at 80p? For what joy? आप समझते हो 80p मतलब क्या होता है? और टेक्नोलॉजी बोला TCS 4,000, इन्फोसिस 1,900. अरे क्या है क्या? एक्सेंचर वापस 270 आ गया. 267 is the low, I suppose. So there is a lot of hogwash in India in the name of patriotism and whatnot. Please, if I am an investor, how do I care whether it's an Indian stock or a foreign stock? I'll buy whatever is cheap. I will only buy India if it goes down a lot. Otherwise, there is no value. Why will I buy this utility companies at such a ratio, a P ratio? वो टाटा पावर 30 का भाव था, तुम 250 कर दिया या 240 कर दिया, तो 150 आएगा तो हम लेगा ना. ये भाव में वो थोड़ी लेगा. On the whole, our market is just checked up with thin volumes. There is no depth in the market. And as we see in technology, how it went down, how it cratered. Similarly, all these banks, if you compare JPA, Morgan, or Goldman, or Bank of America, Citi, those metrics will be ultimately prevailing in India. You can't value banks like this as if it is a, I don't know what. So I would say it's just a minor correction of a down move that we went to 18,000. So again, we'll reach 12,000. Now, having said this, 12,000, 15,000, whatever, there are certain pockets where India Inc. is doing very well. If you find the spots, you will make tons and tons of money. And if you buy this nonsensical crap, it's useless. And lastly, mutual funds have around 38 lakh crore and FIIs have 41 lakh crore. वो 41 lakh में से 2 lakh भी बेच देगा ना. Now there is no space that the domestic can buy, and this buying was done at the behest of the uh, government, LIC, NPA, CPFO. वो अभी नहीं है पैसा उनके पास में. अभी तकलीफ आने वाला है और तकलीफ आएगा. थैंक यू.
Thanks, Sharadji. I am just going to move to Deepak. Deepak CV. I mean, I have of course started out with my analysis and picture of the markets, which is also that rotationally we've seen different sectors peak out over the last 6 to 8 months, some of which broke out of multi-year trends. But as we have done that and we've overshot to the upside, whatever the valuations be, in a world where we are tightening liquidity, would we really see, if as interest rates go up and there's a linkage between rates and valuations, would that really bring down valuations if we continue to maintain the growth argument or that the macros of India is good argument? So, how are you looking at this entire thing? As a lot of discussion has happened over decoupling and so many other topics over the last 2 weeks as we've hit the 18,000 mark and tried to break it, and accordingly how you're positioning for it. Take it away.
Thanks, Rohit. Just one quick note. I don't know what's going to happen to the market. I'm more of a person who reacts than tries to look at where it's going. Roughly speaking, if you look at the macros, quite favorable to be honest. I've seen credit growth come back. We're seeing a lot of interesting statistics in terms of transactional movements. See, the GDP in general is basically recorded GDP. जो भी आपको दिखता है वही record होता है. A large part of GDP is not recorded. Your haircut at your barber and all of that stuff. Many of these things will not be recorded because it's just too small to be. And with UPI coming in and GST coming in and some of the benefits trying to kick in, the actual GDP recorded might actually look higher simply because more items are getting recorded. So the macros will start looking good, but this has a very different effect on credit because if you have more formal economy stuff, credit can increase. Credit increases, a lot of the formal economy pieces increase, which means the banks will or certain NBFCs may do well. There is much more potential growth in the future. Now I'm talking really long because macros don't work in the short term; they work in the long term. So the next 6 months may still be horrible for India. Remember that it was not very bad for India from a macro perspective. We didn't do that badly. We were still fairly positive on real GDP. Yet our market fell 60% in that time. So although it recovered in a year after that, but the macros were not bad. It was just the market liquidity took away a lot of this. So I think focus now, if you're looking at the macros, things are okay, stable, things are good. In fact, looking forward, there are some issues. Some rural parts have declined quite substantially. There are some the issues are mostly about the rich getting richer and poor getting poorer, but they have more political ramifications right now than markets will actually cheer these kind of things. But if you look at short term, the liquidity pressure um, is probably the one that is changing the game now. What we keep thinking and looking at mutual funds, no, and I think we're looking at the wrong data, is we keep looking at equity fund में कितना पैसा आया. अभी equity fund में last month 6,000 crore आया, which is came to basically what they call growth funds, equity or largely equity kind of funds. So you say, oh, it's fallen from 16,000 crores to only 6,000 crores. It's very, but if you look at ETFs, index ETFs and other ETFs all put together, most significant amount of this money might actually be coming into equity index ETFs, which is 15,000 crores last month. So there is a significant amount of buying, and some of it is very small amount of it is retail, but a good portion of it is also institutional, which buys like an EPFO buys into ETFs and all that. So that effectively is domestic buying. Now, I don't know how long that will last, but if that remains, 15,000 crores a month is 1,80,000 crores a year. That's a fairly large chunk. So even if we lose another chunk from FIIs, there will be, I think there will be some part of it absorbed by this layer of index ETF buying, which is where FIs play in the first place. So liquidity is the key monitorable now to say ki where are we going to go. If liquidity falls off a cliff worldwide, all markets in the world will lose money. All markets, not just India, and not India will not be decoupled in any way. If liquidity goes down very slowly, India has a relatively better chance. Remember that our own central bank has reduced liquidity by 10% from the peak. American Fed's liquidity, whatever they are talking about quantitative tightening, has reduced their balance sheet by 1% from the peak. So we are way ahead in terms of, of course, ours was not entirely uh, voluntary. We had to reduce it because reserves were being sold. But RBI has done a good job in cutting down that, because so that we don't get affected by inflation going forward, and keeping the rupee or currency relatively stable. Uh, your your point about liquidity, I think, is if there's a big gash in liquidity, like it happened in Lehman. It was very sudden when the liquidity just vanished off the market. That can happen even now if a large player goes bust worldwide, financial player that goes bust. You can't predict when that happens, but that's the monitorable. So if your liquidity goes for a toss, Indian market will fall big time, and as much or even worse compared to the West. If it goes down slowly, as much as they're trying to taper it and all that, without any of these extreme events, I think we'll probably do better than the West. We might still correct. There's no doubt about it, because you can't continue to. We are what, plus 1.3% in 2022 compared to minus 18% for the US S&P 500. So we've already outperformed a fair amount. So थोड़ा सा तो बनता है. We might give up 5-10% here and there, and that's fair. If it falls 10%, I don't think it's a big deal. But I think the main knowledgeable is. I'm sorry, I'm not very like. I'm not like कि नीचे ही जाएगा या ऊपर ही जाएगा. I don't know whether नीचे जाएगा या ऊपर जाएगा. But I think it's important to monitor liquidity, and I am still participating. So I'm like, until it shows signs of extreme weakness, there is no reason to kind of say कि खेल खत्म हो गया. Don't stay invested. I think when the time comes, you have to move. The time has not come yet. That's my point.
Deepak, Amol here, Amol Joshi. Thanks for touching upon the index fund perspective. I think we missed that in the previous conversation. But I specifically, what drew my attention is your probably last bit where you said you are still participating.
I make something. I can't hear anything.
Can others hear me? Can anybody confirm? Rohit or Jay?
Yeah, we can hear you, Amol.
Okay, great. I'll ask a quick question, Deepak. In your last conversation bit, you mentioned that you are still participating. Now, we also know...
I'm done. In case I'm off the stage.
Okay. I think it was still a broad question. Deepak also manages PMS, and I think Rohit, what do you think about the valuations now? When somebody like Deepak, who also manages portfolio PMS, who says that I'm still participating, and until I see the weakness. So, what is the kind of valuations that you think where the real buying will come? शरद भाई, आपने भी बोला 12,000 18 महीना पहले था, तो अभी 18,000 होने की कैसे क्या जरूरत है? तो क्या लेवल आएगा जिसमें आप सभी सुनने वालों को कहेंगे कि इस लेवल पे एक इस मार्केट में एक लॉन्ग ट्रेड बनता है? आप वैल्यूएशन के हिसाब से भी बोल सकते हैं, या तो हम एक निफ्टी के लेवल पे भी बोल सकते हैं. What are your thoughts?
मैं एक बात जानता हूँ, निफ्टी 7,000 होवे, 25,000 होवे, 10,000 होवे, whatever is the Nifty level. There are pockets, there are stocks which are evergreen, which might go down 5% or 10% at the most. So invest in them. And okay, I am against this nonsensical stories about India. But one thing I know, 5 years, 10 years, 15 years, my stocks will be up by 5, 7, 8 times from here. That's for sure. My view is on the indices, where all the crap, large crap is included, like Infosys and HDFC Bank and Asian Paint, where I cannot invest, but I can definitely invest in a lot of stocks, and I will, or rather, I have created humongous wealth. And if I'm alive, yes, I will be creating much more than that. So I don't buy because I love India. I buy because I see a prospects of a company. Patriotism and all, if I want to really show, I will pay my taxes, do my civic duty. That's it. I won't buy shares to prove I am an Indian. No. So there is a lot of patriotism in the market, which is really very stupid. And believe me, I strongly believe if you are in the right stocks, you will make a fortune from uh, at 17,500 also, and Nifty goes down to 12,000. I'm sure there are not many, but at least 100 of shares where your wealth will double, triple, 4 times in 5 years. So I'm not bullish on the market. I'm bullish on stocks and very, very, very bearish on the markets. That's my take, Amol. And Amol, one suggestion: don't overanalyze uh, things. Keep it very simple. Buy what is good, sell what is bad. ज्यादा मगजमारी नहीं करने का, इसने ये किया ना उसने वो किया. Why waste time? इतना टाइम अगर आप ये क्या बोलते हैं इस स्टडी में लगाओगे, क्या लेना है, तो आपका पैसा बनेगा. एक पॉइंटर है, एक 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 क्यूएसआर है. कितना मंदी आएगा कोई हिसाब नहीं है, 12,000 हो जाएगा. ये जुबिलियंट फूड है, वो अभी तकरीबन मार्केट कैप है, 1 लाख हो जाएगा और 2-3 साल में. ये क्या बोलते हैं वेस्ट लाइफ है, 12-13 हजार करोड़ है, वो 30,000 हो जाएगा. ये देवयानी है. ऐसा I like such stocks. I invest in them. And another pocket of investment which you will not like is MNCs. Just by engineering MNCs, go to sleep. Your money will double, triple, of 4 times. But if you are talking of HDFC Bank and all that, it's a lot of crap, nonsense. Why should you buy a bank at such high valuation? For what? Instead, you buy MNCs because, and the major advantages, out of 100% equity, 75% is held by the promoter. So, on an average, they are generally 10 paid up and a capital of 10 crores. So, how much is a floating stock? You don't have to worry, I'm selling or Deepak Bhai is selling. आप लेके बैठ जाओ, वो बढ़ता ही जाएगा, बढ़ता ही जाएगा. So my investment philosophy is very simple: MNC and some good stocks. Rest all the market short. You see me in trading time. Anything वो बोला अंबुजा ले लो, मैं बोला लेता हूँ. अब 50,000 बेच दिया. जिधर कोई बोला ले, उधर बेचने का. और एफएनओ मार्केट बेचने के लिए ही है. अपने लोग आप पागल है कि एफएनओ में लॉन्ग जाते हैं. एफएनओ मार्केट नेवर शुड बी यूज्ड टू बाय. इट्स not at all tax efficient. If you want to buy in B group, where the Our taxation is only 15%, and here if you're running more, तो 42%, तो फायदा क्या है तुमको FNO में लेके? Anyway, and Indian markets, I want to bring to your notice, are geared towards a bearish person. I will explain you how. You buy in futures, you have to pay a contango. So every month, 10 yearly 10% is taken out of you. You are long. End of the day, delivery, compulsory delivery, तुम भागा दौड़ी करेगा. So और सामने आर्बिट्राजर ही है, उसको तो कोई फर्क नहीं. So I feel, and there are many other reasons why I feel FNO is a contract for the bears and not for the bulls. Yeah, Rohit bhai, thank you.
Yeah, thanks. See, one thing which, and I'll start taking on questions from, there are a lot of people who are requesting to speak. We'll try to get in questions. I'll just highlight, see, one thing which is coming out through everyone's concerns is simply two things. One is valuations and liquidity, and I think that was my central point at the beginning, that even if all things all remain equal, these are two that are most closely being watched. And if we see liquidity tightening incrementally, automatically we start looking at valuations that come off. The only reason why valuations are very high, I think, is because of excess liquidity that has been floating around the world, and then it has got cornered into some stocks more than others, which is why some appear less stretched than others. But there are many where you open up the numbers, and we end up looking at P's of 80 and 90 and 100. Nowadays, even 400 and 700 for a particular group. And there also ownership is very high, which is 70%. But if valuations have gone that extreme, does it even make sense? Is a big question mark for a lot of people. Should we only chase momentum? Should momentum investing be the way to keep doing things, or should we really pay attention to value? Because eventually, if you overpay for something, I remember, if I go back to the tech bubble, tech stocks were growing earnings at 100%, but we are also seeing P ratios going up to 300, 200 for many of these companies. And eventually, once that popped, Infosys took more than a decade to really come back to the peak that it made in Y2K. So that is sort of what ends up happening when we overpay, which is why, and liquidity is been one of the drivers. And when we are in a tightening environment, just like Ritesh said, don't fight the Fed. And if they're, as long as they're moving in that direction, we don't really want to predict that they're going to pivot, they're going to change. I'd rather stay with what they're doing, which means that accordingly I need to position myself. And my sense is that means, for me, that at least meant significantly increasing cash, something which individual funds can't do. But as an individual investor, I can easily do that, and which is sort of how I have done. So I'm weighing in risk that the market can drop. If this is a top, and we've seen multiple tops since October to now, almost 9 months, at 18,600, then 18,300, 100, and now 18,000. Now these are all four multiple lower tops, and at each of them we have seen one or the other sector indices peak and after that stop performing. And so if that is what we are doing, we've probably seen all sectors peak out over an 8-9 month period, and it is time for them to do some kind of pullback. Now we can argue what is the size of that pullback. On my monthly charts, the level comes in somewhere between 14,000 to 14,500, with the risk of a overshoot on the downside, which is what I've mentioned. What I'm trying to though get at is, from different opinions, is how we should look at this situation, because this is purely what my charts and my macro outlook is telling me. As Deepak mentioned, sometimes we can look at this thing incrementally, because if liquidity is going at a slower or faster rate, can determine whether you get that overshoot or whether it becomes one more normal correction in which stocks that are doing well continue to hold out, which is also sort of what Sharad's long-term investing style is. So each one has his own style. Okay, before I take on further other speakers, Fact Finder, you wanted to add something?
No, I wanted to pose this question to both Deepak and Ritesh. Ritesh, you've been looking at both equity as well as debt, right, in your previous role as well as even the current role. and specifically in the context of India. The one thing that's very clear is that RBI also, has been tightening liquidity, and I think that will continue because they also realize. I mean, if you go back to the expansion of the M3 in India versus the GDP growth, there's been a substantial expansion of M3 that does not justify the GDP growth that we've witnessed over the last 2-3 years. So in that context, if you look at how credit growth is picking up because driven by inflation, and since 70% of corporate credit growth is nothing but working capital, and be that if that continues, at the same time RBI tightens, liquidity remains tight, and then you have your deposit rates eventually going up with a lag. If you look, I mean, if you listen to all the banks, they actually, some of the banks like Bandhan Bank are now offering 7.2%, which is not a bad deposit rate. And as time passes by over the next 6 months, let's say deposit rates go up even further. When, in your view, would that push the asset allocators, even within the debt mutual funds and the equity mutual funds, or the advisors, and say, listen, it makes more sense now to reallocate money away from equity towards debt, because now your deposit rates and maybe your corporate bond rates are looking far more better and attractive. So that's one point. The second point, and this is a completely different question. If you look at there's always been an argument in the past that India deserves a premium because India's ROEs were always superior to the rest of emerging markets. That's not the case anymore. India's ROE is similar to emerging markets, and so does it justify the P premium? And if you look, I was just looking at the US. The US, S&P 500 is now at 16 times, forward. The Nifty is at 21 and a half. Even the Nasdaq, which has really cash-rich, great companies, is at 22 times. We've never had, this small a gap ever before. So in that context, does it make sense? I mean, does India offer any value at all?
So the first question is easier to answer. Fixed income today is more attractive than equity, and going forward, the way banks' credit growth rate is there and the deposit growth rate, uh, the deposit rates or corporate bond yield, anything which you talk about on the fixed income side, will continue to move up. And a time comes where this becomes far, far, far more attractive than the equity, and the equity valuations have to correct. It can be time correction, it can be price correction. But in my view, today, India's fixed income assets offer better risk reward than India's equity. The second question is a little bit difficult. But yes, if India continues to have such a high valuation without an increase in ROE, as you said, and other markets continue to correct, then the money will shift from India to those places if there is a sufficient gap between the two. India is a part of globalized world. India is not a separate island. It's a fungible money. The money can just always move out from India to other emerging countries also, which might be much, much cheaper. So this is how I answer these both questions actually.
Deepak, do you want to add anything to that?
Yeah, so I'm the opposite side. I don't think fixed income is attractive at all. At these levels, fixed income yields are terrible for the kind of risk that fixed income has. For instance, you're seeing HDFC price 81 bonds, which are like super risky, even worse than equity kind of risk, at 7.8%. Is not compensation for any risk at all. In fact, most long-term AAA bonds of corporates should have been trading at 9% plus by now, and they're not. So it's not attractive at all. At 9% plus, maybe, but um, I don't know if it's getting there because there's so much money in fixed income just chasing these to a point where the 10-year. I mean, today also the government offers better returns on its government bonds than most banks offer on their fixed deposits. Whether this goes up or not, I don't know. But I can tell you this: you cannot have a Bandhan Bank offering 7.2% on fixed deposits, while 1 year government T bills 6.4, or even more than that, I think sometimes. So your spread between something like a Bandhan Bank level risk is only 0.8%. It's just terribly small. So you're not actually getting paid for risk at all on the fixed income side. So whether this happens or not, we'll see. There is almost very little of this concept of asset allocation difference between debt and equity that happens in a reality. India is a very, very different market. um, Foreign investors don't come and do debt arbitrage because you can't. Until now, there's a new set of bonds. It's actually changing the bond world quite dramatically because they have bonds in which foreign investors don't have limits. The demand for those particular bonds has started to increase, not just because India is getting into the bond indexes, but because you can actually use these bonds, some of these bonds, for arbitraging between the currency and yields on both sides, especially because there's particularly a 2024 bond in there. It's very archaic thing, but you have there are opportunities. So earlier they could not be harnessed, now they can be. So the debt market attractiveness for foreign investors seems to be increasing. For domestics, there is hardly anything that says we will reallocate between equity and debt in any meaningful way. So, if equity markets were to fall, more money will come into equity markets from a reallocation like this. But the amount of money chasing something like this is really small. So, I don't think relevant overall. Um, I also feel that so there were times, for instance, in 2013 when income interest rates were were increased to 9%, and that was, I think, on the 10 year. The 10 year was at 9%, and corporate bonds are higher. That was the bottom of the market. From 2013 onwards, that low was not seen at all. I think in fact, it was not even seen in the low of COVID. It didn't go that low. So essentially, uh, higher interest rates or a rising interest rate regime may not necessarily uh, create a a high in the market and push markets down. Our markets behave very differently. Secondly, on this, what was the second part? I think it was about. Uh, uh, I forgot the second part of the question. So my question on the bond market thing is, I don't think yields are paying much. They need to be paying a lot more. And I don't know if equity is offering enough of a reward, to be honest, because equity is overpriced, but it has been overpriced for so long that um it sometimes makes me feel like, why should I even predict that it's not giving me a return right now? That's what I don't know the answer to that right now. Expensive it is. It has always been. But क्या करोगे, expensive है ही तो. And our markets are expensive because of lack of float. The float in a lot of stocks is controlled by a very, very small number of people.
So Deepak, I'd like to amend my statement on fixed income. The government bond yield are very attractive currently. The corporate bond spreads are one of the lowest. This is simply because corporates have not been adding capacities in India, so they do not need to raise big amount of money for in corporate bond market for and if there is not supply of paper, the spreads do not offer that kind of risk reward as of now. But the kind of announcements which I've seen on the capex side in India in the last 6 months tells me that there is a huge supply of corporate bond coming in India. And as soon as a huge supply of corporate bonds come, and if there are not enough deposits in the banking system, these bonds will be available at a very attractive yield. And that time is coming, in my view, within next 3 to 6 months. So today the government bond yields are attractive. Yes, corporate bond yields are not attractive, but I think that time is coming in 3 to 6 months.
Okay, there's a small thing here. Corporates in India don't borrow that much from the bond market. They borrow from banks, and when they borrow from banks, they create deposits.
Yeah,
So
Deepak, it's the same thing. Either ways, first they will obviously want to go to their banks for that, But if banks do not have deposits, then banks will increase the deposit rates. The marginal borrower in corporate bond market, maybe not the AAA guy, but the AA plus guy or the AA guy, smaller NBFC will have to start offering much higher yield to attract deposits or attract liabilities side to fund the asset side in the country.
तो वो तो हो रहा है. What I'm trying to say is corporate, we are talking about the industrial corporate, because capex comes from industry, not from
Yes.
company. So
Yes.
capex based corporate is borrowing from banks. He's not. He should be borrowing from the bond market. That's, I agree with you. But he's not. They borrow from banks. When banks lend to a corporate, they create a deposit. अगर आपको पैसा मिलता है बैंक से, बैंक गिव्स यू मनी, इट्स अ डिपॉजिट प्लस क्रेडिट एट द सेम टाइम. बैंक्स इन्वेंट मनी, राइट? सो बैंक्स आर लिमिटेड ओनली बाय द कैपिटल दे हैव. टुडे दे हैव excess capital to a certain extent, and therefore it is not deposit constrained. The system is not deposit constrained. In fact, banks have excess SLR to a very large extent. So they can move out of government bonds to fund, and that's what's happening. That is why credit growth is much higher than deposit growth, is because the excess SLR, the excess amount they held in government securities, is being reduced, and lending is coming into the retail market. So there is no new money being created here. It is just a reallocation from here. Now, when capex based borrowing happens, new money will be created. You will see money supply increase, and the excess liquidity that sits in the RBI. I'm sorry, this is very esoteric, but it's just a point to be made. The excess liquidity that sits with the RBI will go to a deficit liquidity, which means currently banks are parking 1 lakh plus 1,000 crores, 1 lakh plus crores in RBI as excess liquidity. Much of that will start getting parked as CRR, and the excess liquidity will reduce substantially. Of course, RBI itself is reducing liquidity by getting dollars out of the system, so they will also be responsible for part of it. But what I'm trying to say is they're not. The system is not deposit constrained. You may not see deposit rate hikes right immediately because banks are still flush. They will raise, the deposit rates will rise at a little bit further down the line. And even if deposit rates were to rise before that, and already it's happening by the way, the banks themselves will borrow from the CD market, which is the certificate of deposit market, at much higher yields. They're currently borrowing at relatively benign yields. So they will borrow from the CD market at higher yields. Part of this process is already happening, but it has not resulted in higher deposit rates yet. And I think it will be very interesting to see how this kind of pans out. I think credit growth may not actually go that high, given the other constraints that we have right now, especially this US recession and all that.
So Deepak, I'll just close it by saying that our liquidity has come down. Excess liquidity has come down from 10 lakh crore to 1 lakh crore, which or everybody know around it. It's coming almost to a nil part over here. If the credit growth rate is much higher than deposit growth rate and credit deposit ratio continue to move up, then banks will have to willy-nilly add give attractive rates to savers to push money from either consumption or from equities into saving product. And I think we are very close to that because our government borrowing is crowding out the market for private borrowing. So if private borrowing also were to come in the with whatever capex has been announced, it will lead to spread widening. It will lead to attractive corporate bond yield in the next 3 to 6 months. That's the whole point I'm trying to make over here. Sorry, Rohit, I have to log off now. I'm sorry about that thing. Okay.
No problem. Satish, thanks a lot for joining in and for your views. We'll catch up again. Thank you.
Thanks, everybody.
Yeah, Deepak, my second question was basically about, in the past, there was always a justification that India's multiple should be, was justified at 100% premium to, emerging markets because, ROEs were far superior compared to emerging markets. That was all the way back from 2006 all the way to 2010, 11, 12. But ever since then, what also happened is that you had a lot of emerging market companies like Tencent and Alibaba, which are high ROE companies, or TSMC, which became which today is the largest index stock within the emerging markets basket. All these companies came to the fore in the last 10 years, and as a consequence, the gap of ROEs between India and the rest of emerging markets has pretty much come to a zilch, from being almost half of it. Well, at the same time, however, the P multiple premium in the last 4-5 months has expanded dramatically. This kind of premium has never existed ever before. And it's not like I was looking at Nifty earnings, because you were mentioning that things are really good. But when I look at Nifty earnings estimates on Bloomberg, at least this year, FY23, there is a earnings cut of about 2 to 3%. And we haven't even seen any significant cuts from IT, for instance. We have not seen, a fair bit. If you look at the earnings growth contribution to the Nifty, about 30% comes from Reliance and about 15-20% comes from ONGC. If you break it up. And with crude oil correcting and refining margins also correcting fair bit, there is bound to be some bit of problems. I was also looking at some notes from commentary from the likes of Hindustan Unilever, and they were also through broker analysts who actually published reports, and they were saying that July August has not been all that good as well. So I'm just trying to understand, which pocket, apart from autos, where there is a shortage, of course, which are the things where you're seeing a lot of bullishness from the broader economy? I was looking at mobile handset sales in the in the quarter of June, for instance. It was down 5% quarter over quarter, and 25% down year over year. So I'm just trying to understand your thoughts on the general economy, and why you're saying that earnings are very strong.
Okay, so my exact statement was earnings from the March quarter to the June quarter have actually increased quite substantially. That is the sum total of the statement. It has no predictive concept in it. It is just a fact. It is not a prediction. So the Nifty earnings from the March quarter end to the June quarter end has gone up a fair bit. I think if you look at the Nifty EPS, that's gone up quite substantially. Now that might change based on how things do going forward and the relative weights of different earnings. And you're right. Some companies will take the lion's share, but some companies always have the lion's share of earnings. It is not that today it's Reliance and to ONGC, tomorrow it will be something else and so on. The um, the other part about India getting a PE is justified. I don't think our PE was ever justified in my mind. We were always just premium for the heck of it. That Sharad Bhai says, for what joy? We have been paying that for what joy for ages. Uh, it was for what joy in my mind, even at 40 PE for Asian Paints. Now it's even worse at 80 PE for Asian Paints. I don't understand it. So, to me, instead of, I mean, I'm looking at it as saying I don't understand why they're paying this fee, but I will. I mean, somebody is paying it obviously. So a good part of it is probably explained by float. That means you have less float in a lot of these companies, especially the MNCs. One of the reasons why they do really well is because वो float पकड़ के बैठे हैं सारे लोग, कोई nobody sells. So, because of that, it's that hodl funda in Bitcoin. You just hold it and nobody sells it, and therefore the price stays up. That's how many of these stocks, including MNC stocks, remain at these extremely insane levels of PEs for a very long time. Uh, I'm not. I'm not saying that's a bad thing because I've benefited from it, but I'm saying that's probably a reason why you see premiums in India compared to the West, or perhaps compared to other emerging markets also. The other aspect of this is whether earnings are good going forward or not. I don't know. If Nifty estimates on Bloomberg can be trusted, then why do we need Nifty companies to announce results at all? Because you can look at the estimates only, but they have never been right, as far as I know. There has been almost no time when the Nifty estimates consensus on Nifty earnings growth estimates on Bloomberg or any of these guys has ever been anywhere close to reality. So if they predict a -2%, you can expect the range is plus 25% to -20%. It is that wide a range that you should expect if you are going to trust over the past. Here again, I'm not making a prediction. I'm just saying from the past data, it is that bad that their predictions are so widely wrong that you should actually put an error range of that much on their results. So I don't know whether earnings are going to be great. Obviously, there are going to be cuts because worldwide recession. There'll be export cuts. There'll be people who are exporting to Europe who are going to have a horrible time in winter. There is going to be that part is given. I don't know if that is going to be the reason why India gets derated or something else. But my thing is, it will not be fundamental. The reasons will be based on liquidity, and if there is, and there is one extra factor that has come in the last few months, which is that India has a lot of domestic capital, which I have never seen something of this level of craziness happen in. As in you've seen it in some leveraged part of the system, future, short-term intraday trading and trading
Yeah,
on
that
margin and all that.
last
Right now, that has come down.
that last part, Deepak, I think is most interesting. That we always look for leverage as the problem, whether it's been through the FNO or Badla market in the old days, or whether it is through companies borrowing too much. And this time, you're actually seeing cash level participation driving up, prices like crazy, like we recently saw in a lot of the holding companies shooting 20% a day. And those kind of moves actually make me concerned because even a CAT, say, for example, I looked at historically, I have never seen the stock move 20% in a single day in its history. And then you wonder what really happened that made it do that on a single day at that point of time. So it's been pretty wild in terms of what is happening on the cash side. I think the only time I can recall where cash market participation was high and peaked and when leverage was low was actually 1994, because post the Harshad Mehta boom in 92, Batla had been banned, and then the cash market was the only thing which was active. And through the peak of mid caps continued to rally. There were a lot of IPOs through early 94, and that's when a lot of cash market activity finally peaked and then rolled over. So that's just history. I don't know whether the same is happening now, but it smells when I look at those kind of 20% moves happening widely, or you look at Adani Group stocks running at 700 and 400 Ps, which we don't know how to justify, except that their holding is 75% with the promoters and then various holding companies or institutional holdings, which means the floating stock is very low. And as I was having a discussion with someone, I really wonder why, if the float is so low, I mean, theoretical float is there, but it's really not there, that they are even getting included in the main indices. So that's the interesting part of the market story. The only reminder of another group that got added to the index is not a good one. So I'll just take on with those my thoughts, questions from a lot of people who've been waiting, so that we can come to a closure on this. Khyati, you have a question? You can open your mic and shoot.
Just one thing, Rohit.
Hi.
Usually, my view is that when a holding company starts moving randomly, right, that is a dangerous sign. Typically, because people have lost, have run out of ideas otherwise.
No, but then when have we seen this happen the last time? That is my question. To this degree.
Uh,
Yeah.
yeah.
Khyati, go on.
So, Rohit sir, I think the crux of the discussion was that basically, it's about liquidity, and
I think she's in listener mode, Rohit.
I can hear her.
Yeah. So the crux of this discussion, I think, is that we need to keep a watch on liquidity and whether there will be excessive tightening given the inflation numbers. I was just reading Zoltan Polster and his theory on the U.S. dollar and on what how U.S. is or the U.S. economy is looking, and what I gather from there is that. The inflation that we are trying to fight, with rate hikes, is basically this time not driven by like previous cycles. It is not driven only by elements on the supply side or the demand side. This is more of a geopolitical man-made kind of a situation, and hence only rate hikes will not kind of help us do that. And and for that reason, and also because we're coming out of a pandemic, and so many things have gone wrong. So to set the economies back on track, I think central banks and governments all across the globe are trying to do their best. And and I don't see the US 10-year yield going more than 4.5, 5. We're already at 3 approximately, if I'm not wrong. So if it goes beyond that, I think the entire economy will go into a very, very, very deep tailspin, and I think that they won't let it happen. So I don't see further tightening beyond 100 or 1.5 kind of from basis points from here, 100 basis points from here. And if that is the kind of tightening that we are looking at, because it will need support. You cannot withdraw the state that it is in right now, in terms of everything, the housing, the new orders, the hope parameters. Basically, it doesn't look likely and prudent that they would do more than that anytime in the future. And for that reason, I don't see liquidity really collapsing at a very fast rate. Another thing, we've been observing that we have been comparing the past in terms of 2008, what happened, and before. But 2008, typically what happened was we were already, we had already, if I'm talking about India now, globally this happened, Lehman Brothers happened, and India had two things going wrong there. We had the twin balance sheet problem, and we had also gone overboard on the capex. We were on the top of the capex cycle. This time we don't have a twin balance sheet problem. We have a good credit growth, and we also haven't really started the capex. We everybody is talking about it, but on the ground, like there the FM was also kind of reaching out to people and saying that, yeah, everybody's talking about it, put the money, show the money. So it's not, people are really still hesitant. So I gather that it's not going to be all downhill from here, and probably the kind of growth that we see as second half of this year. The RBI also in its June report had said that we will see a little bit of a slowdown, and they also anticipated demand and earnings might drop off a little. But I think if you're forward looking mechanisms as a market, I think FY24, a 950 to 1000 EPS on the Nifty doesn't look too ambitious.
Dhani, you had something to ask or add? Okay, I'm not sure if she's connected. Chetan?
Hi, I think thanks for hosting. The basically the question was, how long do we think that US and Europe would take to resolve resolve the inflation, resolve the balance sheet tightening? Because Fed, it looks like they are starting just now, and they'll start at the next cycle of the mortgage backed securities. But how long would it take to resolve all of these issues? And then obviously the points that the other speakers raised about India having like being one standard deviation away from emerging market valuations, and also like not looking very attractive for a emerging market desk, for example. What do we expect that in terms of the stagnation that should be derived from this kind of a valuation?
I didn't get the second part of your question, but on your first part, at least on inflation, if I just go by the research that I'm reading, the data is likely to drop only to 7 point something by December, and probably closer to 6% by March. That is the current trajectory on which it's going. So it's dropping pretty slowly. It's not like they'll raise rates once or twice and you'll quickly get inflation back at 2%. So that is not happening, and that is sort of the fear. And this whole drive between they will not do anything versus will they continue to do. If we listen to their intent, which is we want 2% inflation, and it's not happening at the current rate, which means they continue to raise rates at least 6 7 times more before it really happens. Now the only counter argument is, well, that would be too hard on the economy and they won't do it, which means then they will start to accept that higher rate of inflation at some point of time, which is something we don't know. We are speculating, we don't know, they are not saying it. Until they say it, should we listen to the Fed or should we fight the Fed? So that's what I think Ritesh also highlighted. We don't want to fight
So
the Fed unless they really change their stance. I think that's what it is.
So everyone is looking at a 6 to 9 month stagnation period, right? And
Yeah,
everyone is looking at resolution coming gradually to the fore, and obviously every problem gets resolved. Be it the the Ukraine war, or be it the natural gas price. Eventually, people find a solution, and people find a a point of inertia, and they agree to keep moving forward in life. But
yeah,
like, if we think that 6 to 9 months, or 6 months to 1 year is like the time frame when all of these things, some of these things will get resolved, and then but then for that 6 to 9 month period, India looks like it is the only bright spot where where the EPS is like at least like staying afloat, thanks to the the banks who are experiencing credit growth, and their balance sheets are clean, and there's uh, uh, yeah, I think that's the only bright spot in the sectoral picture in the Nifty. But also Reliance is doing okay, not too bad. So if we say that we are like a semi bright spot in the in the gloomy stagnating period, it still feels like we've achieved quite saturated valuations, no?
I would think so. And that was the reason to highlight that if you think 6 to 9 months of a period where liquidity is tightening, what is the downside risk that we would want to price in? Deepak mentioned if it's slow, then 10% is normal, but we wouldn't worry about it. If it's fast, then can it be more, is something that I am looking at, because when I look at data, it seems to be changing very fast. And at least for the next quarter or two, that is the case. So, yes, why are we paying this price when you have 6 to 9 months of trouble ahead of us is the big question. And that price is also specific to there may be few stocks that you think have value, but there are so many spots where it starts to look very quickly after you had a good rally, like we've seen right now, say in the auto stocks and all. After that rally, suddenly it look like, well, we are paying a lot for the underlying growth. So that is really the big question here.
Yes, I think the problem and the solution both is actually the DII SIPs, right? The flow keeps coming from the SIPs every month end or every start of the month. It just keeps coming into the system. So I think that is the only differentiating factor that I can see compared to a Brazil, or compared to a other emerging market, that this SIP just keeps coming, and obviously this liquidity gets deployed. I'm not seeing any mutual fund house saying that we are going to sit on 12% cash, or we're going to sit on 15% cash. They're all deploying the cash regardless of what the valuations are.
Yeah.
But any thoughts on that? Like, that is not going to reverse, right? If Because when we were looking at 15,200 or 15,500 in June, I got a call from a very very susceptible investor, and he told me, what if the SIPs slow down? We would fall further. And I was like, well, this what if is like a very big what if. I don't think that can ever happen, but that was the big threat that he was seeing. And now on the upside, it's begs a question, why wouldn't they start sitting on cash, or why wouldn't they be a little bit prudent on how to or like how to basically allocate assets between cash and equities, to at least like try to get to their their mandates allow them to get to up to 10 to 15% cash, is what I'm saying.
Yes, but if you heard Ritesh in the beginning, he said that that's not how they behave. So the
Yeah.
behavior be that they will deploy if possible, and so this is where behavior historically what we've seen is basically everyone is behaving as a crowd. Okay, so we think that somebody should behave a little more intelligently, but that sort of doesn't happen. Now I will tend to sound contradictory to what people do because I do things a little differently. For example, in my long investing career, I've always preferred to be a direct investor in equity. I've never owned any mutual funds with no love hate relationship to mutual funds. But I think if you can find five good stocks that do well, you'd rather hold them to perpetuity than average out, because the time you actually move towards funds and larger occupancies is when your wealth has become large and you're in wealth protection mode, which is when you want to over diversify and go into systematic plans and so on. The other one who do SIPs, which you're talking of, are essentially newbies, which is people who are just starting out in the market. They don't know what to do. And the easy solution for them has to be start with an
Yes.
SIP. And if the market falls, it doesn't matter to you. And if they're in the early stage and they're investing their first 50,000 rupees of their life and they're 25 years old, it actually might not matter on a 20-year basis what they really invested at that point of time and what
Yeah.
that were. But if somebody is really deploying a larger amount of capital, if I have like 50 lakhs, 1 crore, 5 crore to deploy, would I simply be doing it in the same way? And the answer is probably not. Then I
Yes.
would
Yes.
thinking about things like valuations, liquidity, and logic. So, would I really buy something that is extended in valuations? A mutual fund has is sort of doesn't have much of a
Yes.
choice. There's a
So
to how much cash he's going to go into, and he might be reactive. In the sense that he may react to when the market falls. He will slowly decide that okay, maybe I need to raise cash. He may not decide immediately, not on a five
yes.
percent, not really do anything like that. He may continue to deploy. So, and
Yes.
the
So I think
SIP, same is
this
with SIP.
answers the previous question, right? That if this financialization of savings is going to continue, and the people are going to keep coming to the equity market, they are going to keep divesting their real estate, they are going to keep divesting their gold, etc., and and also, like, a lot of people, new people who come to the start earning income and like come to the labor force. If they are going to keep using mutual funds or NSIPs as an asset class, then it acts as a supporting layer for the Indian markets and the lofty valuations it enjoys. And the second point that the fact finder was asking, that even if our ROCs are like now very ordinary, and our P ratio is still very high, that it basically answers that question, that if this trend is going to continue, and we think that people are increasingly going to go from a 3% equity asset allocation to a the US average of 20%, then the 17% gap is what is causing us to have like a seriously lofty valuation, and making all the emerging market desks wonder when will this end. So it just looks like there's a problem. But, I mean, it's not a problem. It's just like a nice thing to have, if you're invested. But actually, there's no solution. It's literally kind of like we are investing in a stagnated market, which enjoys lofty valuations, and we try to compound our investments by the growth rate, uh, and hoping that the valuation, the P multiple, will sustain.
Yeah, so most of the times during a bull market, these things don't seem to matter. So even Deepak mentioned people have held MNCs forever. They go through cycles of higher and lower valuations. If you take a 20-year chart of P ratios of some of the MNCs, you find they'll not go below 30 rarely, and they probably peak at around 70, 80. And that is sort of
Yes.
range. And even Sharad earlier mentioned that has been his comfort zone where he owns a lot of MNCs. So people found different comfort zones in terms of what has historically been true. But again, within that range, are you at the bottom end or the top end? So right now we are sort of at the top end on many of these in several companies. There may be some places where you're not, but lot of the names you are, and that is where the concerns are really arising from.
Yes. And I think it's a testimony to the HDFC guy, Mr. Jain. He spent his lifetime investing in companies which were not frothy. He invested, in ICSCI in when it was down. It was ONGC, OIL, and others. He stayed away from the froth for so many years until he retired. Still did decently well, but still, like I think this was a recurring problem that he was facing with the large AUM that he had.
Yeah. So the starting point makes a lot of difference in that, which is where value investing really takes hold. A lot of people stop talking about value investing towards growth, but eventually value becomes growth and growth becomes value. There's a cycle, and I actually try to map that in context with the wave analysis when I'm actually looking at stocks as to where stocks are in the wave structure versus where they are in the value, and we call that the value wave essentially, and try to look for ideas based on that. So that is sort of what we try to do. So I'm going to take the next question from Amiti.
Haji, thank you, Rohit bhai. I've been kind of tracking this cash flow situation in general, and my larger question is कि हाँ ठीक है, market can will is doing ups and downs, but I've been on a sidetrack. I don't know how much it matters. Like so you're the expert, you know better. But then I have my own sort of metric that I measure. और मैं एक जनरल कैश फ्लो सिचुएशन देखता हूँ मार्केट में कितना कैश आ रहा है जा रहा है. जितना चॉपी market has been very choppy in the last, let's say, since let's only say counted since let's say February. चलो February से market has been very very choppy, but the net cash flow situation, when I say net cash flow, I mean I include FII, DI, and retail. And that cash flow situation, I have my own chart. I create my own charts in that sense in terms of monitoring on a daily basis and weekly basis. The net cash flow is on an upward sort of trend, which then sort of sends me very mixed signals. When the market is so choppy, but the net cash flow situation is upwards, meaning कि पैसा मार्केट में ज्यादा आ रहा है, नेट कैश. तो उसको कैसे हम लोग फिर हाउ डू वी सॉर्ट ऑफ डिसाइफर कि हाँ लाइक कभी ना कभी रिवर्स होगा, वो अलग बात है, लेकिन इतना चॉपी मार्केट में अगर नेट कैश फ्लो प्लस में जा रहा है, एंड आई कैन सेंड यू द चार्ट, आई कैन सेंड यू द नंबर्स, माय एक्सेल शीट एज वेल. तो उसमें कैसे
What is net cash flow? Can you repeat that? How do you
net
write?
cash flow is basically all cash that comes in terms of FII, DII, and retail purchase. As in, like, is money leaving the market versus money exiting the market, entering the market.
No, but Amit, for every buyer there is a seller, right? So how do you have net cash flow positive?
Okay, so for example, if we take only say in terms of DII and FII, for example, if we take that one example, right? वहाँ पे क्या चल रहा है कि mostly when you take DII versus FII, their purchase and sale, their sale and purchase tends to mirror one, right? Do you agree with that?
No, you're right. You're right. No, typically they do mirror to some extent, but the difference is obviously HNI and retail.
So their purchase and sale tends to mirror one, but yet you'll find that the net inflow outflow, if you actually consider all considered in terms of adjusting their purchase and sale, even though it mirrors, you'll find a certain trend, upwards or downwards. Yet, correct? Do you agree with that or no?
No, Amit, for every buyer there has to be a seller, Amit. So
No, that is fine. That is fine.
just saying that your number. See, usually the retail HNI will match with the buy, sell, purchase. Will match
No,
with the
no,
difference between the
no. That
institution.
that will mean that there is no money actually coming in or going out at all.
Yeah, absolutely,
Because
absolutely.
no, no, no. It's about value. It's about value that comes in.
Money. It's the
No,
aggression. That's
it's
the
about
point.
value that comes in. No, it's
No,
so that way. So then, basically, we are static all throughout
so
because
it is the
there always a buyer and seller for everything. That way,
yes.
we're static throughout.
It is the
There'll never be a plus or a minus in terms of cash flow.
You're right. So there is something called which is the point I was making with one of the speakers earlier. I think you hadn't joined at that point of time. Is that if you look at go back to February and March, the aggression with which domestic institutional investors, especially LIC, was buying in before their IPO was a lot more moderate, which is why despite the smaller quantum of selling in March and February, we had a crack in the market, a very serious crack in the market. While if you were to look at May and June, the quantum of selling by foreign institutional investors was much larger than February and March, but you did not have that sort of a dislocation in the market because the buyer, which was again domestic and specifically LIC, was far more aggressive in purchasing. They were not bothering about the price. They said we will buy at any price. It doesn't matter. Typically domestic institutions are very very cost conscious. They if they know foreign institutional investors are selling because they have to sell, they will not come in and buy. They will wait and get a better price, right? But here that was not the case. So what matters is the aggression of the buyer and the aggression of the seller. That decides your price. There is no net money that comes into the market unless there is an IPO or a qualified institutional placement or a secondary placement.
See, I'm just going to throw light on my thought on all this buying, selling, and data. See, when we do data analysis and the way I look at it, very very different from what a lot of people might do. People want to look at day-to-day buying of FII, DI, and predict where the market is headed. According to me, it's a complete waste of time. Okay, the whole purpose of why I have chosen to look at something as some people will call it esoteric, it's not esoteric, something like Elliott wave analysis is because it is a behavioral science. When we say behavioral, it means we are studying crowd psychology, the behavior of masses together, which is seen in price action. So when we look at an index, we are looking at maximum market cap of the index, which means the largest crowd of participants buying and selling something on a day-to-day basis, and they have a behavioral pattern. So that is what the Elliott wave theory is. So when we think of that theory itself, if it is behavioral, and we all know about greed and fear, that when markets go up, people get too greedy, and markets go down, they get too fearful, and so on, which is essentially sentiment. So what we are really trying to do then in the next step is to map sentiment. Okay, so we look at handful of sentiment indicators and try to understand whether people are excessively bullish or bearish. Now, why doesn't a singular buying or selling really matter? Look at open interest in the futures market. Like Fact Finder said, there are equal number of buyers and sellers, and that is how open interest is calculated. Now, we don't understand in real time how transactions are done, but when we actually go to buy a piece of real estate, two people sit on a table and they decide what is the right price. One person says, no, this is too less. The other guy says, this is too much. And then they agree upon a price. Transaction gets done. And that price is finally deterministic. In equity markets, this is happening at such a fast pace. There are multiple people with different buy sell orders, and they're taking decisions on what they think is the right price. And because so many people are participating, it looks like your buying and selling is a demand and supply zone. It's not. Nobody's singular buying and selling affects the price. This is only behavior, it is only sentiment. If there's nobody to buy, who are you going to sell to? Okay, so price is a sentimental thing. In fact, I had a portfolio manager at Sher Khan many years ago, and he was describing P, and he said P is not P. P is perception of earnings. Okay, so I really loved this definition, and I mention it many times and wherever I can. So, moment you talk about perception of earnings, it is no more about earnings itself, right? We think it is some valuation metric, which means कि ये high है, low है. कुछ नहीं है. It is a perception game. Okay, so forget all analysis about किसने कितना buy किया, sell किया. You can't figure out. Operator है, you can't figure out. What you can figure out is mass psychology, which is why we are paying attention to things like too many people are opening accounts today. What is retail doing? Too many SIPs are getting opened, and if we are at an extreme in terms of mass retail participation, the last mirror of that I can remember is 92 to 94, where retail participation peaked, and it took a long period of time for that to really come back. So what we try to do is understand sentiment. So when we look at sentiment, I would actually look at net FIA positioning in the futures market. Are they excessively long? Are they excessively short? If you've gone back and seen my tweets, when we actually were in at the bottom of 15,200, FIs were short up to the amount of 1,45,000 contracts, which was the highest short position since the pandemic, which was 1,75,000 contracts. And when you've seen that kind of an extreme short, it doesn't mean, see, shorts are built over a period of time. It's not when you're going from 0 to 145, the market is falling. But when you've reached that extreme where you have the highest ever, is where markets reach a point where they're going to recover, and that is sort of one of the tools we used to point out that this is probably a good point, because it matches our behavioral study also in terms of wave structure, that too many people were bearish and this is a time from where markets are going to turn up. So irrespective of whether we are bullish short term, long term, we try to take that kind of view as well. The point is, once we are done with that, we reach 15,000, we reach 17,000. Moment we cross 17,000, FIA shorts were gone to zero. Moment we reached 17,500, they had gone to 50,000, and then they started to fall again. Today they are at around 65,000. Yesterday, I haven't seen today's data. The point is, it's not in an extreme. In fact, at the start of this month, we had the highest Nifty futures premium, almost 95 points on rollover from August to September, which was also a signal that that it is an excess when we peaked at 17,900. But quickly later on, those premiums went away. These are different ways you can analyze the market, look at where sentiment is, and sort of that's how the sentiment has been on this whole decoupling theory, and a lot of people buying into the market and feeling FOMO, the fear of missing out, which is why we called our long short report for the month the FOMO report, because we said everybody's feeling this fear of missing out. People were messaging me on Twitter, sir, we are missing out on this rally. I'm like, what are you missing out from 17,800 to 18,100? You're feeling missing out because the small cap index went up for 10 days. And if you have participated in the last 2,000 points, why would you feel missing out? So it often happens because people don't take the right decisions at the right time, and then later on they feel that they've missed out, and then they start getting in at the wrong time, and then they get stuck. So this is sort of historical behavior. And so when we see that behavior, it sort of tells us that we need to hold back and think about what is really going on. So Amit, just answering to that
Can I just maybe rephrase my question, sir? As in, like, do you think the choppiness of the market today is speaking differently from the cash flow situation in general, or is it something that you think is it's kind of normal है, ये तो होता है.
yeah, it's completely normal. I cannot see anything abnormal in the volatility of the market. This is not the most volatile market I have seen in my life. I have seen Sensex at a 6,000 open 300 points higher and lower every day because of Nasdaq, which is crazy volatility, gapping up and then selling off. So that is like, at that point of time, 300 points on a 6,000 index is like a 5% gap up opening or gap down opening. We never used to think of it in percentage terms that day, and there was not enough media reporting it that way every day. Ki itta upar khola and you're watching CNBC all day was not true.
Rohit bhai, I'm not I'm not only about the price action. I'm saying in comparison to like जो like cash inflow outflow जो हो रहा है, जो अभी जो situation जो अभी है, मुझे जो मेरा रीडिंग है, कैश एक्चुअली आ रहा है अंदर, ज्यादा आ रहा है. इन द लास्ट 3-4 months मेरा रीडिंग है कि कैश एक्चुअली ज्यादा अंदर इनफ्लो ज्यादा हो रहा है, नेट इनफ्लो. So in that, in comparison to the net cash flow situation versus the choppiness, that is my question.
No, but I'm saying don't do all that. I'm saying I'm trying to say study sentiment. So can I say today the cash flow is the highest ever in the history of the market? Then it is an overbought signal. Or can I say the cash flow is the lowest in the market? Then I can say it is a bottoming signal because too much negativity is there, or there's not enough cash flow, so people don't believe in the market. Now that is some kind of analysis. Simply putting it over this is increasing or decreasing, and is it the cause of something? I think that doesn't really get me anywhere in terms of decision making on a day to day basis. So I'm going
So
to take the
Rohit,
next. Mitesh, do you have a question? Yeah, Sharad, you want to add something?
yeah, I want to say this funds, the mutual funds or the FIs. There are a lot of QIPs, buried in such things. KKR tells 3,000, ये 2,000 करोड़, तो वो सब तो वो फंड का क्या वैल्यू है, वो सप्लाई का क्या वैल्यू है? तो अगर आप निकाल दोगे वो सब अमित जी, तो नेट नेट वो कुछ लोकल ने लगाया ही नहीं है. दैट्स द पॉइंट है. ये 40-45 हजार करोड़ का लिया, तो 25-30 हजार तो बल्ड डील में लिया है उन्होंने. तो एनालिसिस क्या लिया क्या नहीं लिया. हाँ मितेश भाई.
Hi, can you hear me?
Yeah, Mitesh, go on.
I just wanted to understand your view on the current consumption. With the US economy going down, how do you see the current consumption fluctuating overall with India and exports? Say, example, ITC, HUL, metal, commodities, oil. How does it affect in the next, say, coming 1 quarter or 2 quarters?
See, some of these sectors are domestic, okay, and so the impact is not direct; it is more indirect. And some of the sectors have exports where the impact is very direct because you're either exporting to Europe or US or some of these locations which are slowing down fast. Now, eventually, if that is slowing down and affects some number of companies in the country, and then that has an indirect effect on the rest of the economic growth aspect. So that there's an indirect effect of that. So right now, India, which is sort of the reason why India appears stronger, uh, but there's also this completely different angle, which is the valuation part. So when we look at sectors like when you say consumption, and then I think of FMCG, which is currently at the higher end of its valuation band historically. So I actually wonder whether that would be a sector that would attract my attention, irrespective of consumption. So those choices have to be made in a very on different people would look at it differently. One is the short term cycle, and one is the longer term cycle where we are, and really put it in that context. And if you look at FMCG as a sector, it has actually had 10 years of performance and then 10 years of non-performance. It performed very well in the 1990s, it performed poorly in the 2000s, then it performed very well in the 2010s. I would think that 2020s they would probably not do so well. And you'd probably want to look at other sectors which have just started performing over the last 2 years, as and when they pull back. That is how I think about it.
But what about all the PIL schemes as the government is bringing in? They are putting more and more industry into action. So, I say in the next 1 year or 1.5 or 2 years, we'll have more and more factories starting. Employment will be created, jobs will be created, money flow will start. So, which sectors do you think one should start looking at from if there is a current uh, crash down, whatever we are discussing right now? If we assume that we get a crash,
So I
then
said
what are the good sectors that should start with?
to Mitesh, all the sectors that started to do well between 2020 and 2022, which were not doing well in the last decade, namely power, energy, capital goods. All of these sectors were non-performers for almost 7-8 years. So I think that their time has come. You've just seen the first round of value buying. Okay, and as and when if the liquidity tightening is the only thing which is fighting against the situation, but as and when that's
Hmm.
I would go back and look at these same sectors again, which have just started to perform.
Rohit,
Okay, great. Thank
the
you.
challenge is a lot of these companies that
Can
cater
we?
to the capex cycle, which are essentially industrials, right? Even those stocks are quite expensive. If you look at guys like Siemens, ABB, I mean, they're really expensive.
True, as of now that is true. They didn't go through the deep correction like ABB went through in 94 to 98, or Siemens for that matter. They went through significant cleanups, and a lot of the momentum right now is riding on the idea that the government's doing capex spending, which even I was highlighting 6 months ago, but none of it has really translated into more revenue and earnings as of now, which is why it's looking expensive. So, story versus reality is sort of missing over there. I'll take the next question from Mr.
One last question, Rohit, if you can permit.
Yeah,
What do you think would be a better place to invest, ethanol or EV?
I would prefer EV if you ask my personal question.
Okay, got it.
Yeah.
Thank you.
Vivek Gupta.
Yeah, hi Rohit.
Yeah.
Rohit, I'll be just making some generic statements. I believe most of the people, the intellectual ones, have already made most of the technical statements here. So
Yeah.
I am a retail investor, so I don't understand most of the terms which have been used here. So my only concern is thing is people they go gungo once the market starts moving in a positive direction. They go all in. They start buying. Once the market corrects, say for example we have lost some 500 odd points on Nifty, and people have started talking about 12,000, 13,000 odd levels in Nifty again. So they have been talking about these levels from past 1.5 year, I believe, but the Nifty is really not showing those levels. I want to understand people are so bearish on the Indian markets and they are saying that why Indian market should move up. So say for example if I'm holding some of my stocks, I'm tracking their earnings, अगर numbers आ रहे हैं, कंपनी अच्छा कर रही है, तो मैं पैसा क्यों ना लगाऊं इंडियन मार्केट के अंदर? बिल्कुल लगाऊंगा, सबको लगाना भी चाहिए. हाँ, अगर मैंने जिस स्टॉक में पैसा लगाया है उसकी अर्निंग्स नहीं आ रही है, नंबर्स है ही नहीं है, और वैल्यूएशंस मतलब स्काई रॉकेट हो रहे हैं, तब तो समझ में आता है कि इंडियन मार्केट में पैसा नहीं लगाना चाहिए. लेकिन मतलब लोग बोल रहे हैं 13,000 लेवल आ गया, आएगा 14,000 लेवल आएगा, चार्ट्स पे ये दिख रहा है, चार्ट्स पे वो दिख रहा है. चार्ट्स कौन बनाता है? खबरें बनाती हैं चार्ट्स. एक चार्ट बहुत आपको ब्रेकआउट दिखा रहा है आज के दिन में, रात को कोई खबर आई, नेगेटिव खबर आई, अगले दिन चार्ट डिटीरियरेट हो जाएगा. तो चार्ट्स विल नॉट डिफाइन what we say the levels on the Nifty. That is my personal take. Maybe I'm a permanent bull and I'm really bullish on India. So whatever companies I own, I really do track them at the earnings level. So just me talking about some Nifty. If we'll talk about some 12,000 levels on Nifty, I believe most of the stocks will correct to some mid caps and the small caps. I cannot assume what levels they'll go into. So they are reporting really good numbers. So my only request to the people who are really bearish on Nifty that the message which we should pass to common people like me as a retail investor is do track the earnings. If earnings will come, valuations are okay, their stocks are bound to move up. आज नहीं तो कल वो स्टॉक ऊपर जाएगा. क्यों नहीं जाएगा ऊपर? वो निफ्टी पे कुछ भी हो रहा हो, ब्रॉडर इंडेक्स है, वो कुछ भी होता है उसके ऊपर.
Fine.
दिस इज माय ओनली रिक्वेस्ट.
I love your
Vivek,
argument,
Vivek.
Vivek
No,
ji.
no, just a moment, bro. Rohit, Vivek, since how long you are in the market?
Since COVID,
Okay.
luckily my bad, I never invested much money during COVID, but
Okay.
I've not seen all the cycles which
No, no,
might be which your experience might be having. I know I'm not having that
no,
experience, but
no, no,
yeah,
no,
yeah, go ahead,
no, no,
go ahead.
just a moment, just a moment. If I express my view that Nifty will be 12,000,
Mm-hmm.
you, as an investor, you should
हाँ जी
not be rattled by it. You should have your own firm belief. I might say anything, 12,000, 25,000, but what you believe is important.
No, I'm not
So,
rattled at all. I'm not rattled at all. See, today market corrected some 325
अरे
30
भाई
points
साहब
on
तू,
Nifty.
अरे
मैंने तो आज भी माल लिया सर भर भर के। मैं साइड पे
अरे
बैठने वाले लोगों में
अरे
से हूँ नहीं।
भाई
हाँ जी,
भाई माल लेना ही चाहिए.
बिल्कुल
Every week is a buying opportunity. India
बिल्कुल
is
सर,
a great story. India
बिल्कुल
में
सर।
nothing can go wrong. Our real GDP is 140 lakh crore. Our nominal GDP is 2 lakh 40 crore. Our market cap is 2.85 crore. 2.8 285 trillion, whereas world over it is 60% of GDP. So we are doing very well.
सर
We are doing,
मैं आपकी सारी बातों को मानता हूँ। मुझे सिर्फ एक चीज बताइए, मैंने अडानी ट्रांसमिशन 180 पे उठाया था,
अरे
360 पे बेच दिया। मेरी बात
नहीं
सुनिए, लेट मी कंप्लीट।
नहीं नहीं, अरे
What
you
matters?
talk about
What
stocks.
matters? What
अरे
matters
you
in the
talk
end
about
is
stocks. You talk about stocks, general stocks. Don't
नहीं मैं
talk of
आपको हाँ
Adani.
no I'm not forget about Danny. I'm just giving you an example. What matters in the end is people. I've seen people.
No,
Okay,
no. Why are
everyone
you
has.
arguing, boss? If you are happy, you
I'm
continue
not
doing
arguing,
it.
sir. I'm not arguing at all. I'm just putting forward my point. Okay,
No, but
because there are
what's
a
the
lot of
point?
the
What's the
point.
point?
The point
Charanjit,
is
let him
the
complete.
point is if there
No,
are 10
uh,
companies which you have
I'm
invested
just
in.
saying. I'm just saying.
हाँ जी
You
सर।
are you are arguing. You
मैं
have you have 2.5 years experience. I have 44 years of experience. I must be your not your father's age, your grandfather's age. I know how the markets work. You have much more to undergo and
But I'm
understand.
not talking on your. You taken that question personally, sir. I've never pointed that to you. There are a lot of
I'm
people who
not
have been
taking
very sure.
personal. I'm trying to make you understand that just being in the markets for 2.5 years doesn't make you an expert on anything. I challenge at 44 years also experience. I know only 30% of the market. So I'm also at sea. And my portfolio, if you see, would be massive. But my view is this, my portfolio is different. So having a view doesn't change the fact that you have to buy good shares all the time. Okay?
True,
That's
true.
the limited point.
No
And
point. No point in
no,
arguing, sir. I'm not arguing, sir.
what?
नहीं,
I'm
तुम
not arguing. I'm not arguing with you, sir. I
No,
respectfully
no,
like
no, because
your
you
decision.
because you uttered the word 12,000, and I only on the whole of the Twitter is talking about 12,000.
No,
So
sir.
I
There are a lot of people who are talking, whom I'm
no,
following. They
it
are
was
talking
a
about
barb at
12,000
me.
odd levels.
It was a barb at me. I okay. Anyway, chaliye bhaiya.
I have not taken your name. I'm not sure why you have taken that personally. Anyhow, so
no,
Rohit, what statement I was trying to make here is, so
yes,
in every like, if you'll be selective and you'll be analyzing the stocks which you have in your portfolio, if
mm,
earnings are there in the companies, so it may take some time for stock prices to catch up. It
mm,
may lag for a time being, but if earnings are there, there's nothing to worry about. That
mm.
is what I want to just give the message to the people like me who are there in the call, who might be new.
I'll tell
No,
you
no.
Vivek, why it is important. I can probably explain it in more words than Sharad tried to, because I'll tell you the experience what really happens in real life. Okay,
Yeah.
in real life you might buy a stock which you think earnings are growing. You may buy it for say 100 rupees, and suddenly after 2 years, for some unknown reason, the earnings growth does slow down. Okay, and uh, I have seen stocks that have dropped 90% and then gone up 100 times also. Okay. Now it's all and that whole process has taken 20 years. Okay, so there's a time aspect and there's a price aspect, and there's a good company, bad company aspect. These are all so many different aspects that we are all trying to weigh and measure. I might have the ability to spot a good company, but I might not be able to spot that it's going to go through a deep drawdown. Okay, I might be able to spot something that is consistently growing and does so for 20 years, irrespective of what the market does. Yes, it has happened between 94 and 2000. Infosys did sort of exactly that, irrespective of mid caps losing 90%. So many of them losing their entire net worth. Infosys came out and was growing in the tech sector, and became a 100 bagger in the same time frame. So, if your judgment call is that clear, you're fair enough in your own place to do what you think you should be doing in terms of spotting good companies and holding on to them. The reason we talk about deep market corrections and those risks are that all of us who've experienced it long enough in our time have seen extremely deep drawdowns, sometimes either at a stock specific level or at a market level. And it has affected most of the companies that were appearing to do well, because if you saw the beginning of my argument, it was about liquidity and valuations. What I tried to do, because I've actually invited many different type of speakers, some of which who are hardcore fundamentally oriented, someone who's looking at global macro, which was Ritesh earlier, and the reason were they're very different views from what if I actually go and rattle about what I'm trying to say right now, they're very very different opinions, and I wanted to bring a fair balance to the thought process. But if you think about it, one concern which everybody has raised is liquidity. Now, there's a period of time when we ignore all these macro factors, and markets do well on their own because there's growth, and credit growth is on, and so there's an expansion going on, and you don't have to really worry about whether there's inflation or there's interest rate or anything. And then there are times when that is all that seems to matter, and ignorance is bliss. And during those phases, which is one of them which we are facing right now, that the reason that you have the type of valuations in the market today is because cheap liquidity was available for almost a decade at a global level. Okay, so if you bring down interest rates to 2%, 1%, 0%, in India we brought it down to almost 5% in terms of the RBI bank rate, you will hear that people don't like to invest in deposits क्योंकि एफडी में पैसा ही नहीं मिल रहा है. When I was born, FDs used to be 10%, 12%, 15%. Even in 94, you were getting FDs at 15% from a bank, nationalized bank. Today, you're not even getting 3-4% on a fixed deposit. So then what do you think? How will you grow against inflation? You come to equity market, and equity market valuations go up. So equity market valuations are inversely correlated to the interest rate in that sense. Because if rates are very low, people are willing to pay a higher and higher valuation for equities for higher returns. But what if that reverses on its head? What if interest rates move up? Then suddenly you will not pay the same valuations for the same company because it doesn't make sense. And so this is the crossroads at which we are right now, where interest rates globally are rising, bond yields are rising, and we are trying to judge whether we'll pay the same valuations for these companies if rates rise. And if not, irrespective of growth, you might find a company growing at 20% CAGR. Yesterday you're paying 40 times, tomorrow you'll not even pay 10 times for it in terms of PE ratio. So irrespective of growth, you'll sit through a 50% drawdown. Now, if you're comfortable doing that, completely keep holding. It's a question of style then. You're comfortable, you're sure the company band nahi hoega, they are not over leveraged. Whatever happens to the market in terms of valuation correction is okay, then you're good to go. Many people have sat through such times and not had a problem. So that's the calling right now. I think
Rightly
you
put. Rightly put, Rohit. Right.
this is the calling right now. You have a liquidity contraction, which is obvious. There's no debate about it across from guys who are hard coded fundamentally or me
Yes.
about this. So if we have identified what is the issue, we should know what will be the impact, irrespective whether we are right on the company, not on the company, or whatever.
Yeah, Rohit, my only perception is like people are talking about inflation, but I personally believe, I may be wrong, that inflation is here to stay. So it will not be like we'll be one fine day we'll be saying that okay, now that things have been cooled down and we are back to normal. So inflation is here to stay. That is my personal opinion. I may be wrong about it, but it was nice to hear your views on this.
Thank
Thank
you.
you.
Rohit, just wanted to congratulate or give my regards to Sharad Bhai here because I really liked his one view that index is always managed. And after Adani was added into it from this month end, I think it is really managed. Thank you, Sharad Bhai.
No, so there's actually a statistic, and I was just thinking over it with a friend, and he told me, "Don't you remember that when the biggest IPO came out, which was Reliance Power in 2008, and the market topped out on the day it got listed, it was added to the Nifty, and I actually don't remember whether it was added immediately or weeks after, you know. So just because it had a very large market cap, it got added, and the rest is history. So, why is this happening now and at this point of time? Why was it not in the index when it was actually growing? This has sort of been our historical problem. I mean, the tech sector, tech stocks were not in the index in 2000, but they all got added after the collapse started, or just around then, or a little later after it all happened. So we are so late in acknowledging. So this is how psychology also is, right? Extreme trends. When everything is become obvious, then you accept that it is the only truth, and then it becomes part of the market when it's already too late. So
So Rohit,
Agree.
Rohit bhai,
Completely agree.
in 80s, there was a gentleman called Sumti Jamna, big time speculator, big time. He moved the markets.
Yes,
Then
heard of it.
uh, came Harshad Mehta, big time, moved the markets. Then my friend KP, he moved the markets. Then my enemy, double A, Anil Ambani, he moved the markets. And now, Mr. Adani, he briefly touched number two in the world today, and he fell. Mark my words, this is the biggest balloon that I have ever seen in my life. 20 lakh crore for what? No business. It's going to affect everybody whether they are holding or not holding, because it will have repercussions all over, and this is going to end very badly, very badly, very badly. So I'm saying Sumti Jamna, Harshad Mehta, KP, Double A, and now Mr. Adani. That people say this time it is different. Yes, it is different in a way. Only that the time has passed. But modus operandi, rigging, it's all the same. All the because in markets, parameters are there. You can do only so many things. That's it. So this kind of rigging is unheard of. If it would have been SEC, if it would have been SEC, I don't know what they would have done to this group. Yeah, fair point.
Sorry, no, I sorry if I interrupted. Go ahead, continue.
yeah, so
No, so
Pavneet, you want to ask something? We'll come to a close.
Thank you, Rohit. Thank you for the
Yeah.
opportunity. Rohit, I have a couple of questions. One was pertaining to the liquidity indicator which you had been highlighting earlier, also all through past couple of years, and that was crypto. So, despite the crypto worse, almost like uh, reducing itself to almost 50% or maybe 40% of the entire market capitalization it was holding. I remember it was roughly close to $2 trillion earlier, and now getting reduced to almost like say maybe in the vicinity of $900 billion, if I'm correct. So, despite that, now Bitcoin is holding close to almost like 10 weeks moving average. It is trying to negotiate that. So one question is putting that how do you perceive like for the past 10 weeks this entire thing had been happening, whether the Fed will be raising rates beyond 4.5% or not, and that being a parallel universe, just like India is having a parallel economy running in real estate. Similarly, as you propounded that since this crypto is like a parallel universe all across the globe, so, how is it going to impact, and what kind of levels are you watching there? And second question is pertaining to uh, the this collapse of the Indian markets. If it is going to happen at all, how ferociously do you feel that? Like, how much time it should usually take at this juncture? What is your perception, and what will be your point of negation? Like, at what point when the market goes beyond, say, some levels, and you will have to change your view about markets. Thank you.
Okay, yeah, good questions. I'll answer the Bitcoin one last. The first two, in terms of time, all I've done is take the average length of previous bear markets, which has been typically around 15 to 24 months in India. And if we apply 15 months as a minimum, we would end up at March 2023. So that is sort of, the first thing that we can put at. So somewhere around there, maybe, and afterwards we start looking for that the worst may have come to an end by that point of time. Let's hope. Now that is one. The second is, at what point do I change my view? And being a technician, people really want you to say that after 18,200 I will turn bullish. How I've countered that is that if I wanted to only be a level by level analyst, I wouldn't have spent so much time learning macro, fundamental, and all the cross analysis and how to interlink everything. Because I did not start out in the market as an analyst. I started out, only as a technician. I started out in the market as an investor who wanted to make money. And if you are an investor who wanted to make money, you learned everything that was possible under the sun to make money, which means how to read a balance sheet, how to read a chart, what does economic data mean. And then what was really missing is how do you link all of this all together? Because the economist seems to only be doing his economic work. The fundamental guy is only posting future earnings reports, half of which are based on what the company is telling him. So he really doesn't have insight beyond a point. And so there's too much breakaway over here. So what I'm really trying to get at is that the way I look at markets now, when I connect all the dots, if I think the market is going to 18,000, should it go beyond? Is this a bear market rally or not? It's not just about the level, but it's also about what are the factors that are driving it. What are the factors that are driving the bear market? They are a strong dollar, they are rising interest rates and bond yields. Have these factors changed? And we can study them. The beauty is you can study them on charts. You can do Elliott wave analysis of bond yields. You can do Elliott wave analysis of dollar index. Am I getting a reversal? The dollar index broke out after a 5-year period above 104. So unless it goes back up below 104, this is not a false breakout. And if it does not, then the projection goes to 125 or something at least. So now we have a view of what the dollar is doing and what is the negation. Okay. So if I'm not able to negate my view on that, can I negate my view on the Nifty? Like we have seen Bank Nifty, it has gone back to a double top. Does that mean that the view changes? We have seen the auto index make a new high, all-time high. Does that mean that the view changes? So it really then goes back to see, okay, has something changed in the macro? Are we simply doing a trade, or are we really changing the environment which is worthy of taking an investment decision where you allocate and then do nothing for 2 years or 3 years? Okay, so somehow in my mind I'm not able to see that. I'm not able to see that clarity because we are still tightening, and the risks which are visible in currency and bond markets have not gone away. Until those risks have not gone away and they're still looking at they might break something, we might as well you know take care of what the underlying risks are. So that is my way of viewing the market and taking a view. So it's not going to be single factor and level based, it is going to be multi-factor based. Coming to Bitcoin, Bitcoin has unfortunately become the very thing that it didn't want to become. Bitcoin wanted to be the anti-dollar, okay, but by attracting dollars in large amounts, it has become the dollar itself, which means that uh, instead of going up irrespective of what the dollar is doing, since 2017, you find that its correlation with the dollar index has become extremely high, but inversely, just like gold used to be. So it's inversely correlated to the dollar, except its beta factor is much higher than gold. So gold goes up by an X amount, Bitcoin goes up by 10x of that amount. But then the same way, when the dollar is falling, you'll find gold and Bitcoin both are rising. When the dollar is rising, gold and Bitcoin both are falling, except by more exaggerated amounts. And because it has become such a large amount of money that is in Bitcoin and these cryptos, they are sort of they have become, like I said, the liquidity indicator. So whether I look at the dollar, I look at Bitcoin, one of the two will confirm. Now, if people say dollar is topping out, it's going to fall, I say, okay, fine. So show me a buy signal on Bitcoin. And if I see a buy signal on Bitcoin, maybe the dollar is bottoming out, but neither Bitcoin or gold are giving me a buy signal. Yesterday, gold just broke its last month's low. So when you're doing this kind of multi-factor analysis, one thing or the other is continuously confirming the other thing. Okay, so this is how I'm looking at cryptos. I don't think the downside is done. Your question was how far can it go? I've already written about the possibility of this current leg going to around 12,000 plus or minus. Beyond that, maybe larger legs to the downside develop eventually. We'll see, but that is the current point. Yeah, Pavneet, you're saying something?
Yeah, regarding the multi-factor observation which you highlighted, that like this, only the Nifty index level won't be sufficient enough for you to deduce whether this is a bear market rally or this is a like bull market continuation. You would like to watch whether the dollar index, how is it behaving, or the internationally how the other currencies are behaving, or dollar in particular. Now, we are able to see that the Baltic Dry Index is also going down, and there's a significant dip in the logistics cost that is happening. I think Fact Finder may be able to support that with some numbers if he has it handy. So, if in case the inflation data starts to go in favor of the starts to go in our favor, like for the favor of the equity investors, uh, what would be the first point of your like change in the stance? Like, what would you like to see first? The dollar behaving in that particular fashion, or the inflation coming down, or some
The
other
bond,
like some?
Pavneet, the answer is the bond market. You heard my last two either videos or podcasts. I think one thing I've spoken about it is called it's the business cycle and how the three assets behave. I'll just highlight it very quickly. The bond market is usually the first to top out or bottom out. Equities are second, and commodities are third. Okay, you see this in cycles both at the top and the bottom. So you'll find when the bond market tops out first, interest rates start rising, but equities still continue to do well for some point of time. Then eventually you find that equities are also falling, and then bonds and equities are falling together. And then eventually commodity spikes are there, and then commodity prices top out, and then they roll over. So this is sort of been the pattern over and over again. Not only now, you can go back to 2008, same pattern. The same occurs at the bottom, that usually when you recognize that you are reaching a slowdown resulting in a recession, right? So you're going to see right now we're looking at liquidity tightening. It will result in an economic slowdown for the US. Hopefully that slowdown brings down inflation. But at the point when you're seeing that slowdown get recognized, you will find that bond markets bottom out and bond prices start going up. And when bond prices start going up, that is the first sign that the market is recognizing the slowdown. It's not the bottom, but that is the first signal that okay, now we can start looking for the next equity bottom. And so probably equity prices would, after a lag after the bond market, equities would be the next one to bottom out. Whether 3 months, 6 months after that, I don't know. We won't put a time on it, but that's the sequence that I would look for. So the first thing to look for before even I look for an equity market bottom is going to be a bond market bottom. Yeah, Pavneet.
So by that means you want to see the bond curve inversion to reverse. Like you want the 10-year bond yield to be at a leisure before the 2-year bond starts to go significantly up. And one more thing, have we ignored the advanced tax numbers today? Because as per like the channel checks, what we are engaged into. Yeah, am I audible, Rohit?
Yeah, go on again. You're saying something about the
Yeah, go
advanced
on
tax.
again. You're saying something about the advanced tax. Yeah, what I was saying was that the advanced tax numbers were pretty good. They've seen a big jump over year on year. And the second thing was that the kind of channel checks we are conducting at our end, many of the sectors are seeing that big volumes are being pumped into big distributors, be it FMCG or some manufacturing, housing, and construction. And contrary to what the fact finder pointed out, uh, the inventory for next couple of months is so humongous at the end of the retail distributor and the supply chain that companies have virtually like kind of flushed out so that they can pump up their September numbers. And could that be a reason behind the advanced tax numbers also going up? Because I agree that it is on accrual cycle. It is not billed as per cash. So, would you like to say something about that? Because see, economy and everything is okay. Like I understand that economic cycles do happen, but generally Indian companies and organized sector particularly, they have a habit of running ahead of the expectations and despite underquoting. Eventually, I don't know whether to flare up the stock prices or to make their small-time investors happy. Uh, God knows about it.
Rohit, you want me to answer that?
Yeah, yeah.
No,
Not
no. See,
area.
sorry, Pavni. Yeah. So, see, I'm referring finally to data that is available in the public domain, right? So you have, for instance, at least as of June end, you had, Hindustan Unilever coming out with their results, where they in their, I think their slide 4, slide 5, they mentioned that for the FMCG industry, in the segments that they operate in, as per Nielsen, which covers a large part of their supply chain, they have seen no growth YOY in volume terms. This is not specific to Hindustan Unilever; it is specific to the industry volumes. They have not seen any growth in both rural India and urban India. Now, that was Nielsen working for Hindustan Unilever in all segments in which Hindustan Unilever operates. Let's look at Kantar Global, which is a part of part of its mother firm, which is Group M, is the largest advertising firm in the world. They also have a very similar thing, a system like Nielsen, and they also said that their volume growth has not been, has been slightly pretty much negative for the country, right? So these are public pieces of information. Look at mobile handset sales. This is published by Counterpoint Research, which looks at mobile handsets across the country. That has been down consistently for the last couple of quarters, year over year, and I think for the last 5 or 6 quarters, year over year, it's been down. And handsets, just to remind you, handset sales in India as an industry is as big as passenger cars, passenger vehicles. Okay, it's a not a small segment; it's a fairly large segment. So, if you look at also notes that have been published by brokers on their recent meetings with some of the large FMCG companies, they have not seen a pickup. If you listen to some of the commentary made by the largest style companies in the country, including Kajaria Ceramics as well as Morbi, they have said that July, August has not been good. They are hopeful that September is better. And typically, what happens in every year is that there is always a sequential pickup between June quarter and September quarter because of the festive season. So you'll always, in fact, I think your September quarter, in terms of volume throughput, is the largest quarter in the year, while in terms of actual sales, the December quarter, it tends to be fairly large because of sales. You have, Diwali as well as other festive seasons, right?
Exactly, exactly. That is my point. Is I would I would request you to kindly highlight that when the sales is being pushed by the organized sector, because as such the unorganized sector has gone past in past couple of years due to COVID and all that stuff, and government also finding a chance to oust the people, those who are not willing to be worthy of existing in the system, and those who are playing with the leverage, they are virtually thrown out of the system. So, in addition to your comments, I would appreciate if Srini could put some light on that, because Srini had been working for a big beverage company, and what had been their tendency of billing and then pushing the stock through to the distribution channel, eventually just to show big numbers happening in the September quarter. I agree that finally the sales happen in the December quarter, but what about the wholesales that are being pushed right now in the Shraddh period or the period just before Diwali? Because majorly the billing would happen by the end of September.
Hi, hi everyone. Good evening, Rohit, and a lot of my favorite sort of micro and stock market gurus are here. The short answer is things are very bad, but nobody wants to accept. So fact finder can go blue in the face. I can go blue in the face talking about how bad things are. It's there in public data, but we have very reputed guys like the Lever CEO, Dabur's former CEO. These are very reputed, respected guys. They themselves are saying India has got a structural demand issue. We've not seen stress like this in our careers. तो 40 साल के करियर में क्या स्ट्रेस नहीं देखा उन्होंने इंडियन कंज्यूमर में वो दिख रहा है सो Rohit, if you permit, can I offer some views on the market?
Sure, please go on.
So I'll bring this to this is a marketer's stake, so I'm going to stake my professional marketing credibility. There aren't commentators here who've commented from a marketer point of view. So judging the consumer mood, I know it's done mathematically, but also sentiment. So I feel Rohit, bear market shuru hua kahan hai? We are in that. This is my conclusion now. We're in the last phase of the bull market ending, as you and a couple of the other seniors have pointed out. Topping out is a process. It's not a one-day event like often media projects it later. So, and I just made a quick list, but to give it a simile and to make it short, you remember Scott McNeely in 2002, the legendary Sun Microsystems CEO. He had this article saying, "What were we thinking? Paying 80 times price earnings for companies." And he was talking about good companies like Cisco and all. He wasn't talking about crap companies which didn't even have revenue, like some of the dot-com hypes. So we're a bit like that. So later on, we're going to be saying, what were we thinking? Because right now, I feel the bear market will begin only officially at 14,880, which maybe is in October or early November. So right now, let's do a checklist of the ending pattern. Do we have quantitative information that distribution is happening? Yes. I mean, a lot of the India charts posts are quite clear on the data. Do we want to accept it? No. So diagnosis, denial. Are crazy things happening like a 500 PE multiple company getting included in the index? Yes. Do we want to accept this as a worrying sign? No. We're in denial. Are crazy, never before things happening like holdco companies spiking? Yes. Do we want to accept this is bizarre? No. Not a single news headline. So denial. There's extreme illogic and narrative overload at play, which later on will be what were we thinking, like Scott McNeely said. Number one, I want to point out patriotism. So stocks other than government companies are 60% owned by less than 1,000 individuals. Buying and selling stocks is fundamentally about private profit. So there is absolutely no, contribution to the country one can directly argue as much as people are arguing. It's a selfish act of trying to make money and a perfectly legal and ethical and in a longer term good for country blah. But when price action changes, ये सब लोग भूल जाएंगे patriotism था क्योंकि ये patriotism नहीं है. That's the truth of it. Patriotism, a lot of other things. It's not buying stocks. The other illogic, extreme illogic, is about I'm linked to the world for the upside. So Europe is going to order textiles from us, but not to the downside. So recession in Europe doesn't affect anything here. Same thing in the China plus one story and so on. Another extreme example is capex story. After so much hype, April, May, June didn't show it, but no questions. Just yesterday, you saw the finance minister talking rough at the corporate guys with the Hanuman comment. Why are you not investing in capex? Are you like Hanuman? Do you not know your own strength or the country's strength? The answer is simple. Volume growth nahi hai. There's no volume growth across handsets, across soaps, durables, and so on. So what is happening is now getting clearer in hindsight. Imagine one night of so in sales conferences to close this on a funny note, we would start drinking in the morning, like 12 baje se daru shuru ho jata hai, beers and then shots, and then by the time the evening comes in, it's rowdy. And lots of behavior happens at the sales conference, which later on a lot of senior guys and junior guys fall into trouble about. Now imagine we've been drinking for 14 days of non-stop. So what we are seeing is 14 years of excess of the bull market, and what will bring it to a stop is liquidity. And here I feel cultural issues are exacerbating the bull market, and in India. And I think someone said we are late, Rohit, you said we're late in acknowledging. The Fed has pretty much said in plain English that he will hold rates high until he sees inflation at 2% or lower for a few months, which means he's holding rates high all of next year. But we have a lot of Indian commentators talking about नहीं US में ये होगा, Fed data is showing US economy is slowing. उनको पता है ये सब data. And Americans are linear. It's a cultural thing. Indians are layered. It's a nature of how the world is. So net net, the bull market is just in the process of ending, and we're still in the denial stage. Uh, to talk of a level, I think we'll see our official bear market level of 20% down by early November, and then the bears will come out. Right now, just the late bulls who got slapped around a bit and they've sold. They maybe got FOMO'd in the late rally and now they've jumped in. They got shaken out a bit. The real bear market is yet to begin, which makes sense because if it's such an epic, the greatest bubble we have seen in our lifetimes, a 14-year party of excess, the hangover must be equally legendary. So it'll unfold in unusual patterns, but the excess, as Buffett says, will be equal on the other side. And it's only then we'll know, what were the liquidity issues, who was leveraged. वो सब बाद में कहानी बाहर निकलती है. Right now, we will not be able to spot it. That's my quick take on the market. Happy to answer specifics on consumer trends, etc.
No, it's such a wonderful summary, Srinivas, especially the denial part. There is such a comprehensive list of things where people are not accepting facts that have gone to denial. So it was beautifully summed up, I would say.
Yes. Please make us, tweet thread on this. Yeah, it was really amazing.
I mean, just think of that sales party, Daru ke, under Daru influence, you can't convince Gupta ji, the sales head, he's not a F1 driver and he shouldn't take the CEO's Merc out for a late night drive. You can't convince the junior thumbs up brand manager that he is not Brad Pitt and he shouldn't hit on the very attractive and stern CFO lady. ये सब दारू में जब होता है ना, we've all seen friends, like you go crazy. And you're telling them, but they're denying it. This is the mood I pick up right now. And it's my professional judgment. This is not a casual comment. I've been reading a lot, listening a lot. And so the question is, how will it end? Well, liquidity का answer तो दे ही दिया रितेश ने भी, रोहित ने भी. Sharad Bhai pointed out one of the most classic timing signals. It is the most classic timing signals for India, and we've just had it. So yeah, I'll write a note and post it if you want. I'll make it funnier and write it out. Thanks.
So yes, people will.
Rohit, I had a question from one of the participants who couldn't ask you. He wants to know your thoughts on the Elliott wave view for crude oil.
Okay, to simply put it, oil and equities have been so directly correlated, as is with inflation, disinflation, and so oil prices are headed lower. I think I've written a post on it pointing towards the previous low from which this whole spike to 120.30 happened, which was around I think 70 or 65, somewhere there. That's probably the eventual point where we will start trying to judge whether we have the low point in oil, and maybe it even coincides with the low point in equity. So that is another judgment point we will take. But I think they're still headed lower, so that is not done. Will there be some interim rallies? Sure, that is possible. People will try to guess whether the winter is going to cause an oil and natural gas spike. I thought probably gas more than oil. But as we have seen, when the dollar spiked yesterday, day before, natural gas prices also gave up intraday today. So that is where it's, as the slowdown takes hold, suddenly the demand supply equation starts shifting, and everything that we thought, was in short supply suddenly is in oversupply. So do not outguess what the market is trying to do. I think eventually, once we've discounted what is happening in Russia, oil prices in a natural basis in the given environment would head lower, and that is where we look for an eventual bottom will be much lower than where we are right now, irrespective of near-term spikes in oil prices. So that is my overall sense as where it is right now. And in terms of market sense, I think Srinivas summed it up that you could be at the end of a bull run. Nobody wants to call it here, and I'm not the one who's going to call it 20% down. So some people tell me, why do you want to call it now? Let it at least start falling. But this is just what it is. If the telltale signs are there, we prefer to list them out, highlight them. Personally, I like to take action, and action means that I go cash. I don't know if anybody else feels comfortable doing that. But to me, it has been a long wait simply to see different sectors speak out, because this has been the longest. I mean, I haven't seen a 9-month distribution pattern in my lifetime, and that it has played out in this way is just something that we will probably remember and write books about 10 years later. 1 week back, I put out a post saying that, today we all think who's going to sell, and if a week later the news might be such that you'll really be looking for who's going to buy, and sort of it has turned out that way. Now, what I'm looking at is the risk of how far down does it really go? When do we really start investing again? So those, I think I've tried to answer those questions based on earlier. The questions came in earlier. What are the things we're going to watch out for, from the bond market to oil prices? And those are going to be the reasons which will get us back on thinking about investing. Till then, I'm significantly in cash, and looking at trades in the market on the sell side as they develop. Jay, you want to throw in any final points that I may have missed out? This is where we are. I think the bull run has ended. If it is ending, I mean, it is ended sector wise, one by one by one. Probably we are in the last stocks and sectors standing, and so we are watching for those to reverse, and almost at the edge of it. I think that is what my sense is, and that's sort of what today's sell-off signaled, because all our indicators went into sell again, confirming that at least this current rally is ended. Until we really get any fresh signs that there's any strength in this market, it should slowly spread to all these stocks and sectors. That is our opinion. Jay, anything to add?
Yeah, so I think one thing which people might not have seen the video in which you had highlighted, similarities with 2004. I think, people who must have, who have missed this, must see it on the chart. I mean, in fact, even I was not knowing until Rohit sir showed me. So we kind of had this similar, setup wherein the Nifty had retraced almost 80 or 90% of the fall. And later on, I think BJP lost or something like that. And there was a down circuit or something like that had happened. And there was a deep correction. So the point is that, whenever you see corrective moves, especially in Elliott wave perspective, that is calling for a trouble. Because, I mean, while starting the career, we are always generally bullish. Okay, so that is what we used to do, especially on the PSU bank front, because those stock used to have corrected somewhere around 50-60%. I think it was way back in 2015-16 or something like that. And people thought that it's a bottom. When I started the career around 2013-14 phase, even I thought that no, it's bottomed out and all. But usually when you see corrective moves, which we have been highlighting in India charts as well, uh, you generally don't want to fight against that, because when these moves play out, those are deadly and those can hurt you. So right now, I mean, India has been outperforming, but how far will it outperform? I mean, that only time will tell. But if we have to go by the probability, I mean, each time, in fact, there was some beautiful Twitter articles that I was reading, that even in 2000 or 2007 or something, there were many articles, pointing out that India has decoupled, and India is likely to outperform. But everyone knows what eventually happened. So the point is that there are a lot of risks that we are surrounded with right now. So once those risks starts settling down, maybe we might then have some constructive view on the market. But as of now, looking all at the macro factors, it looks a little difficult market. And people who must have not seen the video of Rohit sir explaining the similarities with 2004, I would request them to go and watch that video. So that's it, sir, from my.
No, that's a good reminder. So I'll just highlight the key fact, because the last time we did this space 1 month ago, somebody came out and he was arguing about a trend line breakout, and even few days ago he was saying watch my video. And essentially the trend line breakout, and why that comparison with 2004 is there was a trend line breakout. So if you saw that market, it was slowly tilting down from January to Feb to March along a channel, and then it broke out of that channel, and did that 80% retracement, stayed there for a few weeks, and then started to sell off much more sharply and much more hard. What we've already seen today is prices have the breakout that we got outside of that trend line over the last week. In fact, probably it stayed, on a weekly chart, it stayed for 1 week. We have back closed inside the breakout point today. So that's in short, it's a false breakout. So we already have a false breakout because it's failed to stay outside, and which is where the whole similarity was. And what followed is what we need to see is whether it similarly gives up at maximum speed or not. We would probably think so. We think, given the global backdrop of how US markets are positioned, just breaking a rising trend line, which usually follows by a significant collapse. In fact, I didn't mention this in the long short report I've highlighted. The S&P is essentially a leading diagonal over the last 9 months. Now, this is a pure Elliott wave perspective. In my history, and having learnt it by making the wrong trades, I learned that when leading diagonals start their third wave down, they often occur in 1/3 the time and cover to 2.618 times the distance, which means it's not hard, it's very, very hard. And that is what the S&P setup is indicating. Whether it happens or not, it's indicating that it's going to fall by more than twice as much that it has in the last 9 months, and in 1/3 the time. Now you mirror that and think about what is going to happen to the Nifty. So that's me ending this spaces with fear mongering. And you can call it that out, but this is what our analysis shows us. And FactFinder wants to add one final point there.
No, I wanted. Can you just will you post that video, Rohit, that you're referring to?
Sure. I think, Jay, I don't know if it's on YouTube. If it is, then we can highlight it.
I think so. It might be on YouTube, or else you might have also, shown the intermarket divergence between the Nifty and Nasdaq. I think Sensex and Nasdaq.
Okay, sure. I'll find it, and put it out again.
So, Rohit, I wanted to make one point. I just, to just say, just 2 points. One is, Eddie, when you make that thread, just add one more point, that in the history of India, we have never seen a corporate buying out the largest cement company with actually no money but only debt, and then on top of that, subscribing to warrants with debt. Okay. Never. I think business schools in India will have to write case studies on this. Okay. The second thing is, Rohit, if you just, since you're spending a lot of time on interest rates and stuff like that, I just want to put this number very easy. It's an easy number to remember in anybody's mind. The world has $100 trillion GDP. We have $300 trillion of debt, and your interest cost is going up by 150, 200 basis points. Even Europe, which was negative, is now going to positive. So let's take 150 basis points into $300 trillion. You're talking about $4.5 trillion of incremental cost that has to come from somewhere.
Yeah, that's huge. And on that merciful note, we shall end these spaces for today. Everyone, thank you for participating. FactFinder, Ritesh, Srinivas, Deepak Shunai, Sharadji, all for, Amol, all for putting in their views and comments and adding value to these spaces tonight. So it's been a wonderful place where, a lot of people with different backgrounds and experience have shared their opinions, that have tried to put it all together. At least one thing is clear: liquidity is the thing to watch. Keep an eye on it incrementally, if not in a big way. It will at least keep you on the right side of trend. Don't try to preempt anything. I think that is at least the simplest conclusion you can take away from here, irrespective of the different opinions that each one might have in terms of how it plays out. So thank you everyone, and I'm ending these spaces for today. See you all next time.